Intelligence that 13% of TSMC's revenues come from the auto sector, to your point, guys. So, yeah, putting together the weakness that we're seeing in EV demand with some of the chip sector, that may be also one that we need to watch.
So let's talk you through these markets. So a positive start is what is expected. So the FTSE 100 is expected to start up by kind of 5, 6, 7, 8 tenths of 1%. The single stories are going to matter here. The CAC looks like it's going to be potentially an area of weakness. So we're going to watch out and maybe see what happens with some of the luxury names this morning. There's already some downgrades coming through post those LVMH numbers.
And right out of the gates, you have EQT, of course, coming out of Stockholm, one of your biggest weights on the Stock 600. This coming off after a wave of downgrades, despite the fact, and this was downgrades yesterday after the bell, despite the fact that they actually have an AUM and outperformance in a lot of their funds as well. Interesting, though, that the market not viewing that as a positive this morning.
I'm keeping an eye on the mining sector, looking for an open on some of these mining companies this morning. BHP out with production numbers, lifted the stock during the Asia session. We also have, during the Asia session, strength coming through in some of the basic metals, the metals themselves. Iron ore prices, for example, were stronger. And this was about iron ore production. So we'll see whether we get some movement higher. Basic resources as a sector do seem to be higher this morning.
SML's bouncing back quite nicely. So maybe we're starting to get an answer. Maybe the TSMC capex story is it got battered yesterday, so there's kind of, do you buy the dip in ASML? But it's interesting, Schneider's also gaining as well. I've yet to see a price on ABB. We'll see when that comes through. I've yet to see an opening price coming through on ABB. Came through in yesterday's session into the numbers quite strongly, so we'll see what the market reaction there is. But Schneider is up. Some of the drug stocks are coming through as well quite nicely. But the oil stocks, after yesterday's big move in terms of those inventory numbers in the States, they're down pretty hard. So Shell, BP, Total, all weighing on the market.
Yeah, we saw a drop of 3% in oil prices in yesterday's session. And of course, they rallied on the back of geopolitical tensions. But, you know, maybe that was even limited to some degree in the very near term because we'd sort of factored a lot of that in. But yeah, they did fall yesterday. Weaker Chinese industrial data, part of the story. Also, as you mentioned, Guy, the US crude inventories.
We talk about these airlines. I'm surprised that you haven't mentioned this yet. EasyJet is higher. give Guy a second. EasyJet higher by about 4.5%. IAG higher as well. The EasyJet story is really interesting to me because they talk about this weight in the Middle East, but they're still saying that volumes are higher, bookings are trending higher. It's all positive outside of that one region. We heard that similar kind of commentary coming out of Ryanair, out of United even, that this regional effect, yes, it's a temporarily a weight, but things are still looking good.
Look, we're back to the Taylor Swift economy. I feel like I haven't spoken about that for a while.
It's the Enrique Iglesias economy, please.
Okay, we can call it that if you really...
What year is this?
If you really have to do that.
Sorry, Chrissy.
That was massive shaming. I am so happy with that.
Check's diary, 2024. Explain yourself.
You know things are bad when Anna Edwards tells you.
and I have no right to correct anybody's music taste, so I just put that out there. Yes.
I'm going to go to the corner and just shame myself. It's fine.
But people are spending money. People still want to travel, and that's the expectation for the summer, that people are still wanting to spend money. And this comes back to I think it was you, Anna, asked this question a little bit earlier on. Do you need to, this is maybe related to the States, but does the Fed need to crack the stock markets in order to take away some of this source of funding that it generated out of that December pivot that people are continuing to spend? And it goes back to the crypto story, it goes back to everything else. So in order to maybe to tighten financial conditions, do you need to crack the stock market to generate that?
And would the Fed be happy to see a little bit of that? They've already
Taylor
created
Swift
a
be
bit.
happy to see that? I don't know.
Does she have views?
Can we just point out, I'm making a hard pivot because I'm still
Reeling.
Shame.
I'm sorry, I made the joke, but he laughed way too much.
It's because it's fine. It was due.
Comedy timing is everything, and Anna nailed it.
Can we go back to, okay, I'm gonna pivot. Jean-Claude Trichet made this point on the stock market particularly, didn't he? He said that he was concerned about what was going on both sides of the Atlantic. And that's, I think, the first time I've heard really, even a former kind of Fed or ECB monetary policy official talk about it in that way.
The last person was Greenspan, I think.
Well, when he was in role, yeah. This is a weird market we're looking at today. So although you look at the overall moves, and it looks kind of positive, doesn't it? We're up 0.25%, not much. But there is a sort of positivity here. US futures pointing higher, as if we're trying to put the losses of yesterday and the tech weakness behind us. But then if you look at the sector breakdown, utilities is the best performing sector. Doesn't fill you with any kind of risk on confidence, does it?
No, but yields are down. That maybe kind of takes us in that direction as well.
Yeah.
Which I think is an interesting kind of part of that story. Very yield sensitive, as are obviously the real estate sectors. We are seeing yields coming down. So we've seen this really, and it's been the rate of change that I think in the bond market that has caught everybody on the hop. It's been this very, very swift acceleration to the upside. What do you now do with those bonds? Do you take profits on them? And I think maybe there's some evidence of that. Or are we in a position where actually you want to start locking in these yields?
Well, we asked Christian Muller-Glissman over at Goldman that very question. Take a listen to what he had to say.
We've been through a few geopolitical tensions. The market has maybe become a bit desensitized. If you have a serious escalation, the bond market would react. And with regards to the auctions you were mentioning, I think that's a concern we've had since the summer of last year, that there is a lot of issuance coming, and investors need to be incentivized to buy these bonds. The incentive can come via a flight for safety bid, or it can come via the yield.
The Goldman Sachs head of asset allocation research, Christian Muller-Glissman, speaking there in terms of what the bull case is for a bond market that doesn't seem to be attracting a lot of buyers. Let's get a little bit more perspective here. Tatiana Grail-Castro, of Musadesh, the public markets co-head, joins us this morning on set. Thank you. Good morning. Thank you for coming in. Where do you stand on the bond story? Is a 4.6% yield attractive to you?
Yeah, good morning. I mean, there are so many conflicting sort of viewpoints at the moment, and also tensions, right? So this flight to safety clearly would be one argument where we would go and say, well, actually, we need to position for that because, you know, there is a big tail risk that something nasty could materialize. Having said that, we also see that I think it's now a 4 times increase in the number of treasuries outstanding. So I think that is something that shouldn't be underestimated, that you need a large buyer base. It is a large buyer market. The other thing is, what is your positioning for? So is it a very short-term positioning? And yes, there are CTAs that trade very, very short-dated, but then other asset owners that they would be longer dated. Is this now the time to come in to be a long-term holder? And long-term meaning, you know, 3 months or even longer than that. And so those are those conflicting zones. Where we stand here is 4.6, you know, is clearly better than 4.2. But at the same time, is it screaming value? Probably not. You want to have some positioning because you want to hedge your bets with regards to the tail risk. But at the same time, is it going to be a screaming buy? And there, I think you should always make some calculations. So, for instance, 4.6%, let's say it goes to 5%, that's 40 basis points on the 10-year with a, let's say, 7-year duration. 40 basis points times 7 is 4.8%. That's a negative return, right? 2.8%. That would be a negative return. So you start with 4.6, you subtract 2.8. All of a sudden, well, my full return for the year is, you know, is about 40% less than what's on the tin. You don't make 4.6%, right? So the downside, I think, is still there at 4.6, but you should make a positive return for this year, but you wouldn't make a significant positive return.
Well, that's on the assumption that yields will ultimately go.
That would be higher, exactly. So what is the other?
Yeah.
What is the other? What is the other? So there, I think, you know, we should be less focused on where interest rates will go for 2024, but what is your terminal rate, and when do we get to the terminal rate? So if you get to the terminal rate only in 26, perhaps, or the end of 25, clearly that has an influence of the rest of the curve. So what is the timing of the terminal rate? And then is where do we go with the terminal rate? And, you know, if we go with the terminal rate just below 4%, let's say, 3.5%, 3.75%,
yeah.
and you think that generally it's about 70 basis points higher from that, if you sort of do the 3 months to the 10-year,
Yeah.
then all of a sudden, yes, you know, you come from 4.6 to 4.2. Same calculations, right? It's the same 40 basis points. So you add 4.8.
Yep.
And that gets you below a double-digit return. Do you really want to take that risk? Then the thing is are you getting paid enough for that upside? And I think that's the way we like to look at it.
Okay, and so if you're thinking about when the timing of when you get to that terminal rate, you're thinking about how sticky inflation is, Tatiana. And you raise an interesting point, which I think is worth mentioning, about the repeated increases in minimum wage that we've seen in various economies. And that takes us back to something we've been talking about over recent months, about real wages, and how real wages are more of a story of 2024, even when we're, well, maybe because we're past peak inflation, as if the wage story is catching up with the inflation that we've seen previously. How does that play out then? It continues to keep inflation higher for longer.
I think generally it is sort of underestimated how many people are at minimum wage or close to minimum wage, and how many people get affected by, you know, that very sharp increase in the UK, in Europe, in the US of minimum wage. And then clearly how many companies, especially smaller companies, rely on workers with minimum wage. Right, so then those companies will be forced to put a price increase through, and there is still this ability also. I think there is little pushback yet to go and say no, you know, I'm not going to accept higher prices. So there is still, I think, this inflation expectation and the acceptance that things have become more expensive, and therefore the products need to be more expensive. I think that is still playing out.
This is a group of people with high propensity to consume, perhaps. So does this bode well for consumption, for consumers?
Exactly. So that would be the demand, sort of would also be stimulated by that. So
doesn't sound like a rate-cutting economy, but I mean, I know we're not talking about a particular geography here. It's more of a global trend.
Yeah. I think it is a global trend, so yes, I think, you know, still being cautious around duration. And the other thing is, oftentimes, you know, we had a sense that investors were blindly going into duration. They didn't really do the calculations. We just very loosely, you know, sort of pointed to just earlier, where it almost seemed like, you know, there was duration, and it was like almost seemed like, you know, the lemmings that blindly go and following duration without really calculating what is the return potential. What is the return at, you know, when it was inverted, when you have an upward sloping curve, when you have a low carry, you don't get the total return because of the slope of the curve. It felt to me a little bit.
Is credit better? Is cash better? Why am I coming out of cash right now if I'm listening to what you're saying right now? It doesn't seem to be a particularly strong argument.
Cash has two arguments for cash. I mean, cash clearly is an argument. Oftentimes it has tax advantages, and you know, and as you know, we were saying the carry is the best really at the cash curve. So the only argument would be that you have a reinvestment risk. But that reinvestment risk would only be if you think that rates are going to rally, and you need to come into rates before that rally happens. If there is a continued sell-off, if there's a
lower.
Exactly.
Bond markets are going high.
Exactly. If there is a continued sell-off, is there continued steepening, then actually you take it, the steepening means the short end performs well, and you still have time to add duration. Credit. So there's two things. One is when everybody talks about credit spreads being tight, we always point out, well, you know, you never go and say the Treasury has a yield of whatever it is. You always point to the different points in the curve. But when we talk about credit spreads, we just take credit spreads. We don't point to the different points in the curve.
Talk me through the points then.
Best value is actually in the belly in the short end. The worst value is in the long end. This is where everybody was buying duration, and it has dipped significantly lower to the long-term average. The long-term average in Europe is still cheap in the belly and in the short end of the curve versus the 10-year average. In the US, it's slightly, inside the long-term average. We clearly never are at the average. So yeah, we still see value in the short end, particularly European investment grade. It's still value. So look at different points in the curve when you talk about credit spreads, not just one point.
In terms of credit, though, is there appetite, or are you seeing growing appetite for some of the riskier parts of the market, or is this still a stick with quality, et cetera? I'm specifically referring to the kind of the high yield market, triple C's, et cetera. You're seeing risk appetite in the stock market. You're seeing risk appetite even in parts of the EM space. Does that translate to high yield?
Yes, to the extent that if people go into high yield, they would be buying a high yield strategy. Within that, so our portfolio managers are definitely still quality focused. Default rates haven't gone up as much as they could have if they had gone through restructurings. But now we see actually even in the bond market that there is not full-scale restructurings, so they're not necessarily classified as a default, but nonetheless you have to take a haircut as an investor. And so that is a new phenomena. We talk about creditor on creditor violence, where there is some creditors that form a group and they've already agreed a restructuring with the company, and then they come out and they push other creditors down the value chain. So there's lots of those things, little games kind of going on at the moment.
Pay attention to the details. Tatiana?
Yes.
Nice to see you. Thank you very much indeed for stopping by to see us. Tatiana Guillo-Castro, co-head of public markets and portfolio manager at Muzinich & Co. Thank you. Live bond maths on air. Always love them. Let's talk about what's happening with the Core 6 this morning. This is what we're seeing, a reaction, obviously, in some ways, to the TSMC numbers with ASML. It's up by around 0.6%, but not an enormous bounce back from yesterday. Look at what's happening with Schneider. You got ABB out with numbers this morning. Nestle kind of so-so, but the continuing declines. It's been a few days now. Novo Nordisk has been soft. LVMH comes back to being soft as well. Yesterday we saw a little bit of a pop, but things turning around. So that's the picture with the kind of the core of this market. What else are we watching? Joe's going to start on my favourite subject, airlines, Joe.
So we will start on airlines, Guy, because they are getting a decent boost this morning. Following that report from EasyJet, the company is saying that summer bookings are strong. The excess capacity has come down slightly, and they've redeployed some of the capacity that was supposed to be used for the Middle East, given the geopolitical situation there. But the other thing, of course, is the decline in the oil price that we've seen since yesterday's close, and therefore potentially reducing short-term fuel concerns for these companies. So Ryanair, IAG, Wizz, all of those stocks getting a decent move, all green this morning in terms of the airlines. Then we'll look at a couple of other earnings stories. We had a few of them in Stocks to Watch. Nokia, as we mentioned, Citi was describing this as a weak start to the year in the telecoms business. 5G mobile network firms still not putting in as many orders as some had hoped. And a big decliner, this one is Stedin Sartorius. Stedin down 16%. Now, this is a maker of lab equipment. They supply a lot to China, and that's where the weakness is coming from. It's medical lab equipment, agricultural equipment as well. And we're seeing that stock down 16% today as their sales disappoint analysts. Now, Deliveroo, a strong report from them. More than 70 million Deliveroo orders placed in the last quarter. That's a lot of fast food, and that stock is gaining 6% at the moment. It has had a bad run, as we've discussed on the show before, but it's gaining today, recovering slightly. The best performer, though, on the Stock 600 is Ikestron. This is an ASML rival. It's a maker of chip machinery. They've got a big order from a US company called Wolfspeed. Breaking news on the terminal just come out. And that stock up around 7%. It's listed over in Germany. As I say, the best stock on the Stock 600 this morning. Then we will take a look at a couple of M&A stories. Firstly, International Distribution Services, the owner of Royal Mail, coming down after that 28% gain yesterday. They have got a rejected takeover bid at 320 pence a share. It's only trading at 270. You might expect it might come a bit higher if people think that deal will go through. Then we're going to continue with the 2000s music subject that you were discussing there, because Hypnosis, Songs Fund, one that we don't tend to look at too much. This is a company that owns the royalties to Shakira, Red Hot Chili Peppers, all these groups, and they've got a takeover bid from a US firm. It's valuing them at more than $1 billion. It is a big mover on the London market today. It's up 31% for a Hypnosis. My favourite ticker as well, Song LN on the ticker for that one. Then a couple of morning calls to bring you ASML. Now, you were talking about it earlier in your Super 6 guy, and we have got the first negative rating on that stock as Santander goes underweight. It's the only sell on the stock following that 6% decline that we saw in the shares yesterday, but it's coming up very slightly today, up 0.4%. As I say, Santander underweight on ASML. Then Haleon, finally, is the Panadol and paracetamol maker here in London, spun out of GSK a couple of years ago. HSBC reckons you should be buying that one. We're up 1%. It's a 370 pence price target, trading at 323. Haleon slightly higher in London.
Okay, thanks very much, Joe. Joe Eaton from our equities team, with all the 90s music references that you need. They just keep coming this morning.
I'm enjoying it. I'm in my element.
These are music references I can understand and recognise, so I'm happy.
To be fair, my kids sing a lot of 80s songs, A, because I probably play them in the car, 80s and 90s. All the movies have great soundtracks these days, and they're all from the 80s and the 90s.
And now we see private equity going after the money behind those catalogues. Really interesting hard pivot back to corporate credit. Not sure how I'd do that one, but really interesting.
You need some sort of musical interlude.
We do. Really interesting the way we were hearing from Tatiana Gual-Castro talking about corporate credit spreads there, and tying in with the conversation we had earlier about maybe whether the Fed is going to be a little happy to see some pullback in financial conditions right now. I actually took that line from something Brown Brothers Harriman was saying. The Fed wants the market to do the tightening for them. Financial conditions remain too loose. Some combination of wider spreads, taking us back to Tatiana, higher yield, stronger dollar, lower equities is needed to tighten conditions. Maybe that's what we watch for as we wait for the next messaging from the Fed.
The markets are in a really tricky and almost overly powerful, some would say, position here. Because on the one hand, you look at these kind of credit markets, valuations are looking pretty good. On the surface, it looks like these are some really healthy companies. But then Tatiana was just making that point. If you look below the surface, there are pieces. There is strains being put even on investment-grade companies. You haven't seen that default cycle that's so traditional. But then, to your point about kind of the markets and where you position, there's still so much cash on the front end of the curve, and the markets are in charge a little bit, to some extent, of the interest rate story, more so than the Fed.
Mark was talking about this earlier. The Fed's lost control of the narrative, and there's a nice piece on the Bloomberg as well this morning talking about the fact that basically the Powell pivot is responsible for kind of where we are, this reacceleration. He came out in December. He's like, "We're good to go, folks. We're going to be cutting."
Surprisingly, I remember
a lot of people
remembering December. That was a big surprise.
And as a result of which financial conditions eased dramatically. How do they tighten them? Maybe the markets got the power to do that.
Okay, the banking sector clearly watching this just like many others. They're coming up, more cost-cutting at UBS. We'll get the latest on the Swiss bank as it continues to trim headcount at the Global Investment Bank post the absorption of Credit Suisse. That's next. This is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges.
What's next?
Was going to keep bringing World Cup. This is a 3.
As the economic picture down.
Is it the OK's getting ready to make a decision?
Let's talk about the banking sector. UBS apparently planning the next round of job cuts, part of the integration with Credit Suisse. The bank has said, remember, that it's aiming to save around $6 billion in staff costs over the coming year. So this is part of the ongoing process. Tom Metcalf joins us now. Tom, what does this tell us about where we are in the process of integration?
Yeah, well, it shows, headcount is still very much one of the things executives are focused on. And this is one of a series of cuts. I think for me, the focus from our reporting seems to be on the investment bank again. That makes a lot of sense, right? Management have been very clear they're not particularly big fans of the investment bank they took on from Credit Suisse. It's that sort of targeted look there. Though we do understand this may well sort of bleed across into wealth management and also even the market side. But it's a good question. Sort of back in last year, the chairman, Colm Kelleher, said, the easy part of an integration is actually the job cuts. The hard part is what's coming in 2024, all these sort of technical mergers and all that sort of the real nuts and bolts of a massive merger.
How does this stack up to other banks? Morgan Stanley, Barclays, for example, has been talking about layoffs as well. Is this just part of the trend?
Yeah, I mean, certainly you look back at 2023, there are plenty of banks cutting, and they're pretty, it's a terrible year if you're a deal maker, basically. I think for me, what's interesting maybe about the timing is in the last few days, you've seen a few US banks come out and basically say, deal making we expect to come back. So, that really helped Goldman's results. It really helped Morgan Stanley's results. So it's interesting, it goes to show, I think, back to the strategy that UBS is doing. They're not trying to be, a Goldman capital markets super focused. They're a wealth management firm.
So are investors focused on these job cuts? Are they focused on whether they miss out on the upside in IB, or what are they focused on, Tom?
I think for me it's something totally different. It is this sort of capital requirements that, the Swiss government has sort of started to moot. So, this was expected. You knew the politicians were going to be looking at this, but what came out recently was, for me, quite a strident stance from the Swiss government that caught me by surprise. I thought it was, more aggressive than I thought. So we're understanding that might be a 20 billion capital hit. So, that puts everything else in the shade, right? It's a question of, how do they sort of raise that money, and does that impact stuff like buybacks, and other things?
Tom, great stuff. Thanks for updating us. Tom Metcalf joining us on what the latest is out from UBS. Up next, we'll get back to the monetary policy story. Cleveland Fed President Loretta Mester says the Fed shouldn't be in a hurry to cut rates. We're going to get more on that story. Michael Gapin, Bank of America Global Research, is going to be joining us next. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
In an environment where the geopolitical risk premium is high, $5 to $10 per barrel, if you don't get headlines with a materialization of the geopolitical risk, I think the path of least resistance for that premium is to drift lower. In our central case of no geopolitical hits to supply, $90 per barrel should be a ceiling on Brent prices this year.
The head of oil research over at Goldman Sachs, they're talking about $90 a barrel being maybe the peak that we get in oil prices at a time when some of their peers, say at JP Morgan, for example, saying 100 may be on the table, not their base case, of course, but you're starting to see a little bit of a contrarian take there coming out of Goldman.
Be interesting to see kind of, it is premised on the idea that we don't get any more geopolitical tension. So that, I think, is probably the first thing that we need to kind of factor in. If it doesn't materialize, then maybe the oil price does go down. So I think we are all still on tenterhooks. I don't feel we've spoken about it since the weekend very much. Kind of what happens next. We're waiting to see what the Israelis are going to be doing. David Cameron, the British Foreign Secretary, was talking about this yesterday. He does expect a response. So I think the jury's still out very much on kind of what ultimately happens there. And if you do get a significant response, maybe oil does push kind of to the upper end. The GS argument is premised on nothing really happening.
Yeah, absolutely. Yeah, that's made clear, isn't it? They talk about $5 or $10 being priced in for geopolitical risk still, and therefore why there might be some risk to the downside. We are showing live pictures of the European Leaders Summit, which is currently taking place in Brussels. Enrico Letta, of course, the Italian politician in charge of coming up with a competitiveness briefing, I suppose, plan for today. We know Mario Draghi is working on a competitiveness report. Well, it's Enrico Letta who's currently with Charles Michel there of the European Council talking about what's on the agenda at that meeting. I mean, dealing with energy challenges is part of what they're doing there in Brussels, because the legacy of those, the reminder that we got of the vulnerabilities of the European economy when war started in Ukraine, Russia's war in Ukraine, that's just one of a number of challenges, competitiveness challenges that Europe's dealing with right now.
Yeah, and it's looking around the world, and it's looking at China, it's looking at the United States, it's looking at what is being done in terms of fiscal policy, industrial policy, and Europe Fed finally is grasping the nettle. It's going to have to make some significant changes here. How does that happen? Does it joint issuance? How do we work through an industrial policy on a sort of multi-country basis? I think so. This summit actually feels more interesting in terms of what we're looking at here, and the compare and contrast across the Atlantic is the kind of the basis for this in terms of the outperformance we're seeing from the U.S. economy right now, and how the Fed deals with that, I think is a really live subject at the moment. We've seen yet another Powell pivot over the last few days, finally acknowledging the idea that the market's already grasped that actually rate cuts are going to become more challenging from here. This is what Michelle Bowman had to say yesterday on this subject.
We've seen over the first few months of 2024 anyway, is that progress on inflation has slowed. And I expect maybe it's even stalled at this point.
Okay, stalled. So what do you do with that? It certainly doesn't feel like you're in a rate-cutting environment, does it? Let's get Michael Gapen's take on this. He is the head of U.S. economics at Bank of America Global Research. He's here in London. Nice to see you, Michael.
Thanks for having me on.
No landing. That feels increasingly like the scenario we're in, and that presumably means no rate cuts.
At least for the time being, yes. I think the message you heard from Governor Bowman and the others is there's enough firmness in inflation that we don't have confidence to cut right now. So the view is you stay pat where you are and look for more evidence. So yes, I think you can argue that a no landing outlook, which is where we are, gives you enough firmness in inflation that rate cuts are delayed.
So let's talk about, a few weeks ago, we were in a scenario where, and the dots kind of back this up, that we were going to get 3 cuts this year and we were going to get 3 cuts next year. Do I push those 6 rate cuts into next year? I.e., do we get none this year but get a lot next year? I.e., we're in a kind of no landing this year but a hard landing next year?
So our view is that probably not. That what you would get is you get a shifting back of the start, but you may get fewer cuts in total.
Totality, okay.
So we slid from June to December on the CPI data for the start, but we took both of those cuts out of the forecast. So we have a higher terminal at 350 to 375. So we think the message would be later cuts, but also policy over the forecast horizon, the next 3 years, that needs to be tighter on average to get inflation where the Fed wants it to go.
Good morning to you, Michael. Thanks for coming to talk to us in London, bringing your US experience, very useful right now. Thinking about financial conditions and where they are at this point, do they feel too loose for the US economy as it is at the moment? Do you think the Fed is going to want the market to tighten those conditions in some form to do its work for it, so it doesn't have to deal with some of the more extreme scenarios?
Yeah, I think broadly that's right. We would say financial conditions are modestly or maybe at most moderately restrictive. The policy rate may be well into restrictive territory. That may be accurate. But the broader set of financial conditions, I think, is only modestly restrictive. So I think what you're getting from the Fed is a little bit of forward guidance action here. Later cuts, maybe fewer cuts, on hold for longer. But they still believe the supply side will keep the economy in a disinflation trend, and they see policy as restrictive. So the answer there is you just hold that restrictive policy for longer. But by changing your forward guidance, you do hope financial conditions tighten and do that work for you, as opposed to having to come back and raise rates, which would be highly disruptive.
And one way that they could tighten is by stocks falling, of course. And I wonder, your economics hat on, the wealth effect from stocks being as strong as they have been in the recent cycle. Has that caught people by surprise, do you think?
Well, I think the magnitude has caught people by surprise. Net wealth in the U.S. is up about $39 trillion since the onset of the pandemic. So asset markets as well as real estate valuations. And that has underpinned a very strong consumer, yes. So, the wealth effect is still there. It works. I think what has surprised us all has just been the magnitude and the sheer size of that increase. It's about 1.5 times of GDP.
Where does the bond market fall into all of this? You've got $6 trillion sitting in money market funds, sitting in cash, driving inflation expectations in terms of the trade. How does that factor into the actual effect that a cut or a hike would have from the Federal Reserve?
So in the sense that if you raise rates, it increases returns on savings balances? Yes. So I think in some ways, if you raise short-term rates, it helps some savers. But it's going to depress activity elsewhere. So on net, you think it slows things down. But yes, the higher pool of cash savings, whether it's on household balance sheets or corporate balance sheets, right, makes it a little trickier to set your policy accurately. So but on net, you'd think higher rates would reduce activity, although you can't deny that some savers are benefited.
But the yields picture is still much, much stronger, much, much higher. And I respect you're an economist, not a market strategist,
Sure.
but there is a dynamic in the market. There's a conversation in the market right now that because there is so much cash on the sidelines, specifically in money market funds, that the markets are actually driving some of the financial conditions, not just out of the stock market, but through the bond market, and has more of a direct effect and more of a near-term effect on the rates picture than the Federal Reserve has. Does that conversation have any merit to it?
Yes, in the sense that what the Fed controls really is its real policy rate, right? So it controls the overnight nominal rate, and given where inflation is, the real policy rate. Financial conditions broadly are determined by financial markets, where yields are, where spreads are, where the dollar is, where equity markets are. So and many things, as you were just mentioning, geopolitical risk, moving oil markets, right? There's many factors that can move those financial conditions differently. So the Fed has influence, but not sole influence on that. So market expectations matter, market views matter, other risk factors matter.
So when the markets fight the Fed, which is exactly what's happening right now, one would argue, it feels like that they're more in charge of the interest rate picture.
Markets are always in charge of the interest rate picture.
More so than the Federal Reserve, though, controlling kind of the narrative more so than the Fed. Has the Fed lost the narrative then?
No, I think the Fed agrees with what the market is saying. I think the speakers that have come out, from Jefferson to Bowman to Powell, I think all agree. We all moved after the CPI data saying, I doubt that gives them comfort and confidence, therefore they should delay. And the Fed came out and said, yeah, we agree we should delay. So I think right now the market and the Fed are on the same page.
When the facts change.
Until the facts change.
Yeah, they feel like they have and continue to keep changing, which is making this so difficult to navigate right now. There's a lot of surprises in there. The Europeans feel like they're on a much more, in a very different place right now. Bank of England yesterday, Bailey talking about rate cuts. He's got a confidence inflation that is coming down. You've got the ECB talking about a similar narrative. How far can they diverge? And because there is a kind of gravitational effect between both markets, both economies.
That's right.
How far can they diverge, do you think?
I think they can diverge, but I think the premise of your question is they can only diverge so far, yeah. and I would agree with that. So if the question is, if the Fed's delayed and we don't really know when they're going to start, can the ECB start in June? Yes. The question is, how many cuts could they get in and how far can they go? And obviously how the currency moves will be a very strong influence on that decision. So my view would be, yes, you can get some divergence, but I would question
how much divergence do you think?
How many
50 basis points, 75 basis
50,
points?
75 basis points.
You could do that, okay.
Yeah, I think so. That'd be about, I think, the limit of what you could do this year.
Okay, and that taps into what we were hearing from Andrew Bailey overnight, talking about how Europe is on a different trajectory in terms of the data, the inflation data.
Right. There's a greater justification for cuts in Europe than there is in the U.S. I would agree with that.
And Bailey was referencing in particular a relative lack of demand-driven inflation in Europe and saying that is still strong in the U.S. What are you looking at when it comes to that demand-driven inflation in the U.S.? What interests you at the sort of forefront of your research, Michael, about where that goes next, that demand-driven story?
Yeah, that's the interesting thing for me. I agree with, so the no landing scenario is premised in part on this supply response, right? The labor force has rebounded. It's increased potential growth in the short run, which gives you higher actual growth, but still declining inflation. I agree with that narrative. The Fed has bought into it. But what I would say is I only push that so far, because a story that starts with a rebound in the labor force ends with greater employment, income, and spending. So what I would look at, honestly, is just when we're adding a few 100,000 jobs a month, that's a tremendous growth in labor market income, which will ultimately lead to spending. It's not so easy to slice it and say, oh, this is all supply, and supply is going to do all the work for us. Yeah. So I would just say, keep it simple. Look at income generation out of the labor market, and that will tell you where the demand side effect is in the U.S.
Is the U.S. outperforming because of fiscal policy, and how does that fiscal policy change around the election, do you think?
I think it's primarily outperforming from this labor market story. Okay. And then the secondary effect, which is still important, is
the fiscal driving. There's a kind of immigration story, but the fiscal policy presumably is having an effect as well. You see it in the payroll data in terms of government spend, in terms of kind of what's happening with the labor market too.
Well, most of that coming out of the labor market is at the state and local level, and it's hiring around education and health.
Yep.
So it has the same feeling of an economy that's still reopening from COVID, where employment and education and health is still below pre-pandemic levels. So I would qualify some of that under what we're calling, the catch-up effect still in hiring. And obviously you need a labor supply story to allow that to continue. So I'd put that under the supply. Okay. But in terms of just fiscal contribution to growth, it's been very high in recent years. So yes, I think it's been an important contributor, but maybe a secondary contributor.
Before we wrap up,
sure.
The election, how does that change? How are you changing your models and your thinking in terms of how that election is going to affect?
Well, I think that the question we all have to answer, and we don't obviously know it right now, is do you get sweep outcomes?
Yep.
The risk I think that the market would point to is to say sweep outcomes where you get an all-Republican outcome or an all-Democratic outcome. The feeling is that could be more fiscal expansionary. Okay. So you'd have to worry about maybe firmer demand, firmer inflation, fewer cuts in that world. But obviously the election in the U.S. is very close. I don't think anybody has a good view on that. We're not here to predict it, so I think that's uncertainty we have to deal with later. But the risk is around those sweep outcomes.
Okay, and that would give more power to do things which might be fiscal. Michael, thank you very much. Thanks for joining us. Really good to speak to you. Michael Gapin, Head of US Economics at Bank of America Global Research, passing through London and joining us here on set as he does so. Coming up on the programme, Europe is watching as industrial policy in China and the United States threatens to leave the continent behind. We're watching live pictures of EU leaders arriving for a summit in Brussels where they're talking about all of these really global challenges, taking on board some of the fiscal spend we were just talking about out of the United States and the policy environment around industrials there. We're seeing them arrive right now. We'll be back to Brussels shortly for an update. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case that
and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today. We are 47 minutes into our European trading session, which shows some upside this morning, up by around 0.3% on European stocks. Now, Europe is watching as industrial policy in China and the United States threatens to leave the continent behind. That's the backdrop for EU leaders meeting in Brussels today, who face tough decisions on keeping the region competitive. Let's get more with Bloomberg's Oliver Crook, who's on the ground as we see these leaders arriving for these meetings. So you could say, Ollie, that alarm bells are ringing. If you look at what's happening in China, has been for a long time, of course, and more recently in the United States. The European leaders, they're arriving now. Are they listening to what we're hearing from the US and crafting a response accordingly?
Yeah, exactly. I mean, you mentioned China, and China's an easy enough topic to address here in this forum, right? To say that there's overcapacity, to say how unfairly European companies are traded, and that tariffs need to go on Chinese goods. That's easy enough. What's more difficult, Anna, is looking in the mirror and saying, how can Europe itself be more competitive? And looking in the mirror, they might see a familiar face, and that is one of Mario Draghi, who has been tasked with coming up with a report to how to make Europe more competitive. And maybe it's just my training, having been at Bloomberg for as long as I have, but when Mario Draghi speaks, we listen. And here's what he had to say about that.
China, for example, is aiming to capture and internalize all parts of the supply chain in green and advanced technologies. The United States, for its part, are using large-scale industrial policy to attract high-value domestic manufacturing capacity within their borders. We are lacking a strategy for how to keep pace in an increasing cutthroat race. It requires us to act as a European Union in a way we never have before.
And so Mario Draghi, Mr. Whatever It Takes, what it takes today in Europe is radical change. He calls it a change that is comparable with the founding of the Union, the compact that had to do with steel and coal 70 years ago by the founding fathers of the EU. Unfortunately for Europe, this tends to be the sort of thing that they are not great at. A massive change that is coming, one that takes a long time. There isn't the kind of urgency that it's tomorrow. It's really that slow walk towards economic obsolescence, which makes it very difficult to crack with political consensus here in Europe.
So, Ollie, walk us through what's actually on the table. When it comes to what these measures look like, what are we looking at?
Right, so we're thinking about how to leverage Europe's sort of strengths. You know, it's not going to outspend the United States. It's not going to have a top-down economic and industrial policy like China. They really need to leverage what Enrico Letta said, which he delivered a 147-page paper that now the EU leaders are discussing, is to leverage the single market. How do they do that? One is through defense spending, and that is going to be through Euro joint debt. That is what he has suggested. And, of course, the Capital Markets Union, which we've talked about for really almost a decade here in Europe. But could this give it the impetus to get that money flowing across Europe? Yes, for the defense industry, but for investment more broadly, that is the sort of money that needs to be tapped in Europe to get this stuff moving. We spoke to the defense chiefs yesterday who say, listen, we need stable and predictable and large investment in this industry if you really want to get the capacity up. And really, there's still a huge amount of debate. Where will the Capital Markets Union be supervised? Will it be out of Paris? We know the joint debt is a massive question. And there's also one last thread here, Guy, is that basically you have this EU election, and in individual member states, you have this rising sort of nationalism and Eurosceptical view. That is not going to make this any easier.
Ollie, I feel like we've been talking about some of these subjects for a very long time. We generally do need a crisis to make progress. Is the crisis sufficient enough to make progress? And how far away from seeing that progress do you think we are?
Listen, I think that there is a degree to which we could make some progress, certainly on the Capital Markets Union. I mean, we heard Enrico Letta walk in. We heard a couple of leaders saying that they were actually optimistic that we could make meaningful progress, even potentially today. I think that when you're faced with this, I mean, Olaf Scholz just returned a couple days ago from China. He touched down initially in a city of 32 million people, right? One that many Germans have never heard of. This is the sort of scale that Europe is facing now, and if they want to remain competitive, they need to figure out how to unleash it. The Capital Markets Union seems to be potentially one that is the most within reach.
Optimistic. When you hear the word optimistic coming out of Brussels, you do maybe pull a face. Ollie Crook, thank you very much indeed. We've heard a lot of optimism over the years. Ollie Crook in Brussels for us, covering the summit. Plenty more still to come from him. We've got some great coverage also coming up out of Washington a little bit later on. IMF and World Bank spring meetings are taking place there. ECB Governing Council member Klaas Knot's going to be joining us. The South African Reserve Bank Governor Lesetja Kganyago is going to be joining us, plus the IMF Managing Director Kristalina Georgieva and Eurogroup President Pascal Donohoe is going to be on Bloomberg a little bit later. It's a busy morning. It's a busy day coming out of DC.
Okay, I was about to go through a list of other things that are happening, but I think I'd just watch those. I think that's
enough, isn't it?
Sounds like a good thing to do. We do have some US data, of course, jobless claims, existing home sales. After hours, we'll also get numbers out from L'Oreal, so a bit of a focus on the consumer there. We had interesting conversations about what real wages do to the consumer story with Tatiana Grael Castro earlier. But also in focus, ECB's Mario Centino will be speaking, more from Michelle Bowman. The Bank of England's Megan Green will be talking. We've had a lot from Michelle Bowman and Megan Green recently, but we'll continue to bring you all of those latest thoughts.
I'll also add that we have Netflix earnings after the bell in the States. And the reason I really like Netflix in particular, yes, it's an American company. Yes, we all want to know when Bridgerton is coming out. That's my investment. But it's also a currency story.
There's something in the past for you to think about. Yeah, something old school.
I refuse to...
For a bygone era.
I refuse to steer into the skid.
Yeah, we're going to leave Critty alone on her 90s music taste.
Yes, I'm going to go lick my wounds after the show. Let's talk about the currency picture, though, because Netflix's growth is more global now. It's hitting the emerging markets. It's hitting Asia. That's their next leg of growth. So the currency impact on the stock and what they do in terms of their currency commentary, to me, has always been kind of this weird macro indicator that nobody really looks at for Netflix.
Well, it's not one that's been on my radar, and you've put it there, Critty. So now I will focus on it.
That and Bridgerton.
I always do find, though, when you talk to CEOs about FX, there are industries where you can try and take structural action to kind of match exposures. But other than that, they just say, we try and look after the things that we can control, and we can't really control that one, so we just leave it alone.
But Netflix is everywhere, isn't it? So presumably some of this is going to even itself out. Some currencies are strong, some currencies are weak. That's the natural hedge that you're talking about.
Unless you are a predominantly dollar-based investor. It's different, for example, and you see this with McDonald's, you see this with Starbucks, and you see this with Microsoft, for example, where so much of their business comes out externally. Netflix doesn't have that yet. They're still a majority U.S. company that is growing elsewhere. So if you have a subscription that's worth $13 in the States, hypothetically, it's priced far less in, say, India, for example, and that exchange rate ends up meaning a lot less revenue.
It takes us nicely into that real wages story as well, real wages for 2024. If they're going to hold up, then that'll put less pressure on consumers to ask whether they really need a million streaming services.
There's a nice story, I think it's a Tag Heuer they're talking about in the story this morning, about how tags have got so much cheaper in Japan recently because the currency's been moving so fast that the retailers haven't caught up. So there's an arbitrage opportunity in luxury goods, potentially, around some of this currency.
My birthday's coming up, Guy. I'm just letting you know.
We're continuing to focus on...
Please don't open the door to me. Some Rico jokes.
We took a deep dive into European politics earlier with Oliver Crook, rightly, because we had... we've got these leaders still arriving for this event. I was told that Olaf Scholz was just arriving, but he's disappeared from camera shot, so we can't show you that one. But he is arriving, and clearly a lot of pressure on Germany right now, because you've got all of these other leaders lining up to say, come on, this is something of a crisis. We need to do something revolutionary. And what does that usually mean? That usually means joint debt, and that's usually something the Germans are not fond of.
But he's just come back from China.
Yeah.
What did he see there?
He's seen the challenge, maybe.
Maybe he's got kind of recent experience of the challenge. He's going to be briefing the other leaders on what he saw, what he heard in terms of what the Chinese are going to be doing. That could be an interesting kind of change of heart, maybe from his point of view. And he sounded that the fear was that he would undermine the tough European line. He didn't do that. He was actually fairly tough in terms of the language that he was using out there.
Well, You've got Germany on board, hypothetically. Now you got to convince all of these smaller states that are worried that the bigger European countries have this advantage because the markets are relatively bigger. They're so worried about this U.S. competition. Yep. The real threats from China. Do you have to convince some of the periphery?
Still about the infighting, perhaps. That is it for markets today. We will leave you with plenty of programming coming out of the IMF. We just showed you some of the great guests that are coming up later on in our programming. European equity markets making modest gains, up by 0.3%, reversing some of the losses in tech of yesterday. US futures pointing a little higher. Have a good day, everybody. The Pulse is up next. This is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Asian currencies push back against a stronger dollar after the Treasury Secretary, Janet Yellen, acknowledged the concerns of Japan and South Korea over sharp declines. Now, global chip makers TSMC expects revenue to jump as much as 30% this quarter on booming demand for AI. That is despite a downbeat report from one of its main suppliers, ASML, earlier this week. And also this week on Bloomberg UK, the Bank of England Governor Andrew Bailey says the inflation risk is higher in the US compared to the UK, opening up the prospect of a rate cut before the Fed. So first thing is first, as always, let's have a look at what the markets are telling us. Now, we did see a little bit of a correction. I don't know whether it's correction, but certainly the dollar seeing a little bit of a dip. Now, stocks are climbing overall with a lot of the earnings actually in focus. The couple of things that we're watching back for is, first of all, Asian currencies rallying as actually authorities are pushing back against a stronger dollar. We had that press conference, and you can see won versus the dollar. We had that press conference by Janet Yellen basically not pushing back against some of the intervention that we saw there. So if you look at won leading the climb in some of the regional currencies, yen steady following this joint statement from Janet Yellen with the finance ministers of Japan and South Korea that noted serious concern about the depreciation of the two Asian currencies. Now, to talk about the markets, to talk about dollar, and to talk about equities, I'm delighted to be joined by Peter Oppenheimer. He's Chief Global Equity Strategist at Goldman Sachs. He's also fairly newly minted author of Any Happy Returns, Structural Changes and Super Cycles in the Market. So, Peter, thank you so much.
Thank you.
And once again, congratulations on the book. There are a million questions. They're extremely difficult, which I'm sure you get day in, day out from a lot of investors. First of all, like, what's supporting the markets? It feels that it's actually only AI almost.
Well, there's been massive concentration in the markets. That's absolutely right. I mean, if you look at the period since interest rates started to rise in 2022, 60 to 70% of the return in the US market has come from those mega tech companies, and the narrative around AI has been central to it. But we shouldn't forget also that there's been a big shift in the last year in terms of expectations about growth. You know, this time last year, markets were pricing a very high probability of recessions, not just in the US but elsewhere, and that's changed dramatically. And if anything, while interest rate expectations have adjusted, people are less optimistic about the speed of rate cuts, they've become more optimistic about growth, and labour markets remain very tight. And that ultimately, I think, is what's keeping risk assets like equities up.
But Peter, when you look at the U.S. economy, I mean, it's really firing, it seems, on all cylinders. Now, there's, some people are saying this is all thanks to immigration, and that's really what's supporting, and you see it, feeding through productivity and things like that. But at the end of the day, it's putting pressure on dollars. So what does that mean for U.S. equities, especially in earnings season?
Well, I think it's important to emphasize how strong the economy is. Despite the rises in rates we've seen over the last couple of years, we think the U.S. economy is going to grow close to 3% this year. Nearly 2.5% fourth quarter over fourth quarter, far from the sort of recession that people believed. And that's down to strong labour markets, immigration, also strong private sector balance sheets. I think it's keeping the market up, but we shouldn't forget it is expensive. The market trades at around 21 times earnings, well above the previous peak of the last 20 years. And we think earnings are actually going to be okay, but not that spectacular. Year over year, earnings growth is likely to slow to around 3% for the S&P, compared to about 8% in the fourth quarter, year over year. So there is a slowdown. And again, most of the growth in earnings is coming from a relatively small number of super large companies.
What do you expect? I mean, again, what's the biggest drive for a lot of these equities? And I know you're you look at sector by sector, you analyze balance sheet. But if China's, deporting deflation, does that help with the Fed, and does that give a lift to S&P?
Well, I think right now the concern that the market is absorbing is that inflation is not coming down as quickly as hoped. So yes, growth is fine, but we're not likely to get the boost in terms of lower rates that the markets had expected and really priced in for much of the first quarter. And I think that's causing some indigestion. So earnings are really going to be crucial here. How do earnings hold up? And particularly for those super large companies, not just in the US, but in other markets as well, because, we've noted that there's been a huge increase in market concentration in most of the major markets. What we call the granolas in Europe, for example, the 10 or 11 biggest companies also make up about a quarter of the value of the index of the 600 biggest companies. So again, what happens there, what happens to the dominant companies in Japan is going to be crucial. For now, they're doing very well because their margins are holding up extremely well. The market expects the 10 biggest companies in the US to actually boost their margins by nearly 400 basis points year over year. For the rest of the market, margins are likely to be flat or slightly down. If margins hold up, I think markets will be okay, but we're looking at relatively flat returns from here.
But Peter, is it really sector by sector? I know the luxury sector in Europe actually gave so much benefits, and now we're seeing even LVMH maybe beating expectations, but certainly on a downturn.
Yeah, because the expectations are built up to be so good for these dominant companies because they've had quarter after quarter of solid margins and decent revenue growth, and they've been relatively immune from rising interest rates because their balance sheets have been very strong. And the market is really bifurcated into really rewarding these defensive growth companies, whereas unprofitable, very long duration growth, which was previously outperforming in the years when interest rates were falling, has suffered a bit because of the rise in the cost of capital. For us, we still like these quality, if you like, defensive growth areas, including things like technology and healthcare, but we also like balancing it now with areas of deep value because there are areas of value industries which have been long neglected that actually are now posting decent cash flow. They're buying back shares, paying dividends, but they really have a significant value advantage.
But is that in the energy complex or is
in
it
energy, in areas like banks, for example, in Europe, which were underperformers for a decade or more, but actually now are generating pretty decent earnings. They're buying back shares, they're paying dividends, but they're still very cheap. So having a barbell between the sort of quality growth, which is expensive, but is posting still very good fundamental compounding earnings, and some of this deep value, we think, in a relatively flatter market environment, is a good way to sort of hedge the risks.
Peter, thank you so much. We'll be back with Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. We'll talk a little bit, I guess, more about dollar strength and what that means for certain parts of the markets. Coming up, EU leaders have been arriving in Brussels, but can they actually come together to keep the bloc competitive? That's the story next, and this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
In terms of where we see Europe going forward, it is recovering, and we are clearly seeing signs of recovery now, beginning timid and picking up in the course of 24. And our forecast for 25-26 is 1.5, 1.6% growth.
Well, that was the ECB President Christine Lagarde speaking in Washington at the spring meetings of the IMF and the World Bank. Now, Europe is watching as industrial policy in China and the U.S. threatens to leave the continent behind. That's the backdrop for EU leaders meeting in Brussels, who face tough decisions on keeping the region competitive. Now, let's get more from our very own Ollie Crook, who's on the ground in Brussels. So, Ollie, alarm bells ringing. Are European leaders hearing them, and what can they do?
Yeah, we hear about Lagarde and the European recovery in kind of the sort of immediate term. What they're really concerned with is the European economy in the much longer term, right? This is sort of a question of competition abroad from China, from the United States. And for EU leaders, it's easy enough to criticize China, to throw up tariffs on things like EVs and other sectors. But the question is, they also need to look in the mirror and figure out how to remain more competitive. And looking in the mirror, they might see a familiar face, which was, in fact, ECB predecessor Mario Draghi, who spoke this week in Brussels because he has been tasked with how to make Europe more competitive. Have a listen to how he summarized the issue.
China, for example, is aiming to capture and internalize all parts of the supply chain in green and advanced technologies. The United States, for its part, are using large-scale industrial policy to attract high-value domestic manufacturing capacity within their borders. We are lacking a strategy for how to keep pace in an increasing cutthroat race. It requires us to act as a European Union in a way we never have before.
And so Mario Draghi, Mr. Whatever It Takes for Europe, what it takes right now is radical change. And that is what is being discussed right now by EU leaders. They've gone into the discussion, and they were discussing a report that was written by another former Italian Prime Minister, Enrico Letta, who put out 147 pages with detailed proposals on how to make Europe more competitive. And really it focuses on the single market, because Europe is not going to outspend the United States. It's not going to be better organized when a top-down approach is China. What it needs to do is have a stronger economic union. So that means he wants to see joint borrowing for defense spending. It means a capital markets union so that capital can freely flow into these companies. The question is, of course, Francine, as ever, the politics. There is resistance to joint debt. There's potentially some room to make that progress on the capital markets union, and all of this ahead of the European election.
Ollie, thank you so much. Oliver Crook there in Brussels with a terrific roundup of some of the longer-term issues. Still with us, Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. And Peter, I was listening to Ollie, and I was thinking, we have very short-term problems or concerns like dollar strength, what the Fed does in the next couple of quarters. And then you have these long competition, like structural reform, the cost of money, the cost of credit. Like you wrote this book also looking at some of the super cycles and structural changes in markets. Is there a danger that we're focusing so much in the present that we ignore some of these larger shifts?
I think so, Francine. I mean, there's so many things that are happening in terms of potential inflection points in the short-term cycle that people are very, very focused on what is urgent, but less on what's really important. And it's often these longer-term structural shifts which really shape the environment for investors and indeed companies over many years. And I think we are seeing some big changes, some of which are being discussed by the European leaders, a pushback to globalization, more intervention from governments in terms of trade policies and tariffs. Industrial policy is becoming much more popular. And of course, we're getting a higher cost of capital. Governments are also raising much more debt, and that's keeping long-term interest rates from falling. And all of this is happening at a time when the world is facing the joint sort of pressures of AI and decarbonization. And so there's a lot to focus on here. Yeah. But importantly, I think in Europe's case, there needs to be also a focus on investment, because Europe is falling behind on the amount that companies are really investing. So some of it is institutional and to do with rules and regulations, but some of it has to come bottom up as well.
So again, what does that mean from an equity point of view? Can you look at the trends now that will really shift and change in 5-10 years and try to take advantage of it now, or you just need to be aware of the forces so that you don't lose out?
Well, I think trying to identify those companies, many of them are in Europe, that are reinvesting and growing because they can compound those investments at a high rate is very significant. It's interesting if you look at the amount of CapEx, growth CapEx and R&D as a share of cash flow that's done. For the big 10 tech stocks in the US, it's around 60%. For the granolas, the dominant European companies, it's 50-55%. If you look at the average of the stock 600, it's about 15 or 16%. So very much less reinvestment is being done. That's about half the rate of the average American company. So I think really identifying who can grow, who has the ability to reinvest, And what they're reinvesting in is a really important point. And where you have mature industries, it's the real focus on shareholder value, buying back stocks, paying dividends. And that's really, I think, what investors have to identify.
And I mean, we talk so much about security. Defense is also something, I mean, unclear whether Europe can kind of get on the same page for that much longer. But is defense a place where we need to look at even
a critical area, Francine? I think we have a defense basket of stocks in Europe. It's been it's up 50% roughly this year. It was the best performing sector in the last 2 years, and there's a reason for that. Governments are having to spend sadly more on defense. This also comes back to the pressures on government budgets, because they're having to focus on defense, they're having to focus on industrial policy, on subsidies and tax breaks to encourage decarbonisation and energy transition, and of course there are ageing populations. All of this means that government deficits are getting bigger, and that's happening pretty much everywhere globally, which again is really keeping longer-term interest rates higher. So, what effect is that going to have on different industries and sectors and companies, I think is a central area of focus for investors as well.
Peter, thank you so much, as always, for coming on. Peter Oppenheimer, their Chief Global Equity Strategist at Goldman Sachs. Now, coming up, we take a closer look at a smart city set up to transform the Athens coastline and boost Greek GDP. Our exclusive interview with the Lambda Development Chief Executive next, and this is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Now, Greek builders Lambda are developing the site of the capital's former airport, which has become a symbol of Greece's economic recovery. The 650-acre site will become a new smart city with beachfront properties, a shopping mall, and a major new park. Well, joining us now for an exclusive interview is Lambda Development Chief Executive Odysseas Athanasiou. Thank you so much, sir, for joining us. I mean, this is exciting because it also shows that Greece has been doing extremely well and will likely continue to do so. What are you most hopeful about in the real estate, commercial and otherwise, for Greece?
Yeah, I believe, good morning from my side as well, Francine. I would say that this project that you mentioned is a symbol of a new Greece, a Greece that is regenerating after 10 hard years that the whole world followed between 2010 and 2020. Real estate is booming, and there are multiple reasons for that. One is that there is a huge imbalance between supply and demand. Supply of new projects has gone down in these 10 years, and demand has gone up in the last 2 years. We got a lot of awareness in the last 2 years, 3 years, because of a government that is very business-friendly. Tourism has come back in big numbers from the US also, but from all the West and Eastern Front around Greece. And in general, we're living a boom that in terms of numbers is shown in the fact that we have about 6 billion euros of foreign capital invested in real estate, mainly in residential, just in the last 3 years, compared to 1.5 billion euros in the decade between 2009 and 2019.
Yeah. And so could you give me an idea of the kind of timeline that we're looking at for the project? So first of all, what's the value upside potential? By when will the first bit of the development be delivered? And when will it be fully finished?
Yeah, the first phase of the project is about to finish in 2026, 2027. And when I say finish, I'm talking about a project that in total has the size of 3 times Monaco, just to get a comparable. And the first phase covers all the coastline of 4 kilometers. That will include hotels, it will include residential, malls, schools, education, and health venues. And we expect about 1,500 apartments to be ready by Christmas of 2026. And the population is going to be there. This is our target, along with a marina in which we're going to have a Riviera Galleria full of high-end fashion stores, F&B, meaning restaurants and cafes, 300 yachts to be there, and many tourists that will have the opportunity to visit what we call zip code paradise. The capex that is going to be invested in this period is close to 3 billion euros. And the good thing about this project is that in just 2.5 years after acquisition of the land, we produce profit in the results we announced yesterday. And the cash collections from the residentials we have sold so far comes to close to 650 million euros. So we're very happy about this because we have brought to the market 500 apartments and they are all sold out.
And so how much, for example, will this project add to the country's economy? Do you have figures for that, or is it estimates?
Yes. Based on independent surveys, we believe that it's going to add to the GDP about 2.5 points, 2.5% in the Greek GDP. It's going to add 70 to 8,000 jobs, and it's going to bring at least 1 million tourists. And we're not talking about long-term future, like 10, 15 years. We're talking about in the next 3 years. As I said, Christmas of 26, we believe the first phase is going to be in full mode.
I mean, we're looking at your profitability. Some of the return on operating assets have been doing quite well, as you're saying, very recently. How much, when the ECB cuts rates, and at the moment markets are expecting a cut by the European Central Bank in June, does that help with further development or just your cost of constructing?
Yes, I'm not sure I heard everything that you said well, but if you talk about the interest rates and the operating assets, is this what you include in your question? Is that right?
Yes, on interest rates and the European Central Bank. If they cut, is that beneficial to you?
Yeah. Look, the interest rates and the trend that they have followed has hurt us perception-wise because, of course, it hurt all real estate stocks globally. And that's why we have a big discount in our share price, for which I'm going to talk in a minute. However, we have locked our interest rate cost because we issued 2 bonds in 2020 and 2022. The fixed coupon that we pay is 3.9%. We're fully locked until 2027, And by the way, these bonds are callable, so that means that if the central banks start decreasing the rates, we are in a position to convert this to variable interest rates from now on. But now we're locked at 3.9. Our operating assets recorded an exceptional performance of 70% last year.
Very interesting.
Yeah.
Thank you so much, Mr. Athanasiou there from Landa Development. He's the chief executive. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Well, good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. The Bank of England Governor Andrew Bailey has raised the prospect of rate cuts for Britain before the Federal Reserve moves. While speaking in Washington, Bailey said the UK and the rest of Europe are facing less of an inflation threat than the US.
We're in a position where we're seeing this process of disinflation. I expect that next month's number will show quite a strong drop because we have a particularly unique household energy pricing system in the UK.
Well, the UK Chancellor Jeremy Hunt says that this week the prospect of rate cuts later this year would lift the mood of voters. Now, he's hinted that the Prime Minister will not call a general election until the autumn. Well, Hunt made the comments before the latest inflation data, CPI, slowed to 3.2% in the year to March, and that's, of course, the lowest in more than 2 years, but a touch higher than expectations.
It's certainly the case that, the feel-good factor as interest rates start to come down, as people start to feel higher real disposable incomes, will be stronger in people's minds come the early autumn than it is now. People have been through a very bruising period. Obviously, decisions about election timing are for the Prime Minister, and were we to have an October election, as I've said before, it would be possible to have a fiscal event in September, but we would decide much nearer the time whether that was the right thing to do.
Well, of course, you've already delivered a lot fiscally in terms of tax cuts, including personal tax cuts, and yet when you look at polls, obviously the Conservative Party is still running significantly behind Labour, I believe by roughly 20 points. What else may need to be done on that front to convince UK voters to keep the Conservatives in power? What would you consider doing?
Well, I'd be very cautious about looking at those polls because, first of all, as we can see from the challenges facing incumbent governments, not just in the UK, but in the US and Germany, France, the electorate have been through a really difficult period with an energy shock, with high inflation, with a pandemic. But when it comes to a general election, it's a choice about the future. It's not a referendum on how you feel right now. And that becomes a very different decision in people's minds.
Well, that was the UK Chancellor, Jeremy Hunt, there speaking to Kayleigh Lyons earlier this week. Now, from the current Chancellor to a former one, Philip Hammond has told me he's positive about the country's economic outlook. Now, he also warned that the UK should only cut taxes once public spending is under control.
I agree with the Chancellor. I think the UK growth prospects are significant. We've got a very good track record of technology adoption. British people are very open to using technological innovations in their everyday lives, more so than in many other countries. So the raw material is there, but we've got to make sure we seize the opportunity. And one of the challenges of democracy, of course, is that we have to persuade people that they want things to change. And people are very conservative, with a small c, often don't like change. And it's about selling change to people, working out how, in a democracy, we have those big debates and we reach the right long-term decisions around these big, difficult issues. Because many of our adversaries and even many of our friends around the world who are competitors with us don't operate the same kind of democratic system, don't have to build the same kind of consensus that we do in the liberal democracies of Europe.
So one of the more immediate, and these are longer-term, extremely difficult subjects, very important. On the short term, I mean, does it make more sense to increase defense spending or cut taxes? And that could also lay the foundation, actually, for future growth either way.
Well, look, I'm strongly in favour of an agenda to cut taxes over time as we can afford to do so. But we can only cut taxes if our public spending is less than our tax receipts. Driving economic growth, achieving higher levels of economic growth should increase tax receipts and should ultimately enable us to have both lower taxes and higher spending on public services, including things like defence. But we've got to do things in the right order. First, you grow your economy, and that requires investment, maybe at the expense of consumption. But the consistent theme, if you look across countries around the world that have achieved decent levels of economic growth over long periods of time, the consistent theme is high levels of saving and high levels of investment. And we've got to do better in that area. Once we've done that, and we're running surpluses in our public finances, then we can start looking at cutting taxes. I'm afraid, as Liz Truss and Kwasi Kwarteng demonstrated a couple of years ago, trying to do it the other way around, cutting taxes first, funding it by borrowing, simply doesn't work.
Well, that was the former UK Chancellor, Philip Hammond. Now, coming up, a stronger than expected UK inflation tempers rate cut bets. We look at whether central banks should ditch their inflation targets for something more flexible. That discussion is up next, and this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising
Yeah,
New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, yesterday, the BOE Governor Andrew Bailey shrugged off a smaller than expected drop in UK inflation. That prompted traders to unwind bets on how many interest rate cuts the bank will deliver this year. But should the BOE drop its rigid 2% target altogether for something more flexible? Let's bring in our panel, Bloomberg's John Stepek and Marcus Ashworth from Bloomberg Opinion. Marcus, I love your piece. So basically, this, you basically argue in your opinion piece just yesterday that it's time to retire the 2% inflation target. I think it's easier, isn't it, to do it in the UK than, for example, for the Fed or the ECB to do it?
Oh, I don't think it's a question of timing. I think they can all and should drop it. Perhaps it will be easier if the Fed does it first, but it might be easier for the world if the Fed cut first, but we may not get what we want. So I just think it's, if we've had this huge Bernanke review, which, one wasn't needed because most of it was absolutely patently obvious. But if the Bank of England does get in reform mode, let's pray they do, why don't they go at it properly and reform the whole regime to create something which makes sense? Because you can't and you shouldn't steer an economy on one constant, literally just trying to aim at 2% the whole time, come what may, because I don't think the economies are quite so biddable. I don't think the inflation data is good enough. It's lagging. They can't calculate it properly. And everything else is beholden to this sort of one rule to rule them all. And I don't think it works. It never worked, in my humble opinion, but it's certainly the benefits it once had are embedded, and I think that they can improve it by having a little bit more flexibility. And let's move away from, oh my lord, it went 3.2, not 3.1. How stupid is that?
Yeah. So John, so Marcus and I usually see eye to eye. On this one, we probably don't, just because they've missed the target for so long. Then if they just get rid of it because it's a little bit high, it just seems like it's gaming the system.
I mean, yeah, I agree with you. I do think the problem is that if you get rid of the target and you say, well, let's be more flexible about it at this point, then as you say, it does look as if they're kind of giving up a bit. Yeah. And also, the other problem is, so what do you replace it with? Because the one benefit of an inflation target is that it's a specific number. Yeah. It's very obvious, it's easy to communicate, and central bank policy is hard to communicate in the first place. So saying, well, what do you make it instead? And I do think that's kind of the big issue. And also, I would say that I'd be concerned if the Bank of England went first, right. Because if we look like we're the ones who are slacking off and controlling inflation, then, I mean, my first expectation would be that the pound would fall quite significantly. Now, okay, probably doesn't matter in the long term, but in the short term, I mean, this is something that I feel probably the Fed has to take the lead on if it's going to change at all. Yeah. And in the meantime, I mean, my own view is that central banks probably we should reconsider the whole role of central banks anyway. So I'm probably not the best person to ask about this in lots of ways. But anyway, yeah, so I think there's a danger there.
Okay, but you're not quite like the Argentinian president, right, who just wants to get rid of central banks. Are you, John?
Let's talk about that another time.
Okay, well, we can talk about it now. But Marcus, so I guess, and actually in your article, again, you put it, this does not mean that inflation should be allowed to rip. I guess one of the concerns that people say is then politically, if you don't have a specific target that you can justify, then politically you could get a lot more heat from the people in charge. And I guess a central bank still needs to be independent.
Yeah, well, it's worked, you say, sometimes not quite as independently as you would think it would be, particularly through QE and matching government issuance. But look, my point here is not to do it at 3.2. My point is to do it at 2% and or below, which is going to happen next month and possibly go down to below 1%. At that point, then is the time to change your inflation target. We didn't want to do it, right in the start of or during an inflation surge, obviously. That goes without saying. And John's point about the pound is correct. You've got to do this in a way which is clearly telegraph what's happening and better in conjunction with everyone else. That doesn't mean you all go to the same range or you change it in the same ways. It's just there needs to be a little bit more flexibility for each economy and changing that range. It just de-emphasizing the inflation target as being something which is the only thing which we can look at as far as monetary policy and how monetary policy works with fiscal policy, because that's what's gone completely haywire. And look what's happening in the States with massive stimulus, which is throwing literally the whole world economy off track.
Yeah, and this, John, I guess, points to the fact that in the last week, we've had incredible movement on the markets, right? Global interest rate markets are basically in a flat spin, bleeding into equity markets. There's been a huge repricing of treasuries.
Yeah.
Is it actually justified?
I think it is justified to an extent because, we're waking up to the fact that interest rates in the US are going to be higher for longer. And, when you think about it, in December, markets were pricing in 7 quarter-point rate cuts from the Fed, and they're now down to, 1 or 2. And some people are even, Larry Summers has said that, there's a 20% chance the rates will go up this year.
Do you agree?
I think that's probably punchy. I'd be surprised if US rates go up, simply because, the other thing is you've got to take into account the fact that this is an election year on both sides of the Atlantic. Central banks are probably now within the zone of whatever they do is going to be seen as political interference, particularly in the US. And so I think that that's kind of politically difficult, despite the fact that they're ostensibly independent. Yeah. But having said that, I think that, markets have probably been a little bit too comfortable with the idea that rates were going to cut this year. And now that they're waking up to the fact that they're not, then I think the repricing probably is justified. And also there's going to be an element of turmoil arising from that.
Marcus, how problematic actually is dollar strength? So we saw Janet Yellen flanked by the Korean, finance minister and the Japanese finance minister saying, look, she wasn't going to push back against intervention. But how problematic is it for the UK?
Well, the UK, we don't tend to talk about currencies. We don't care about the pound. The Bank of England has consciously, deliberately ignored it for many years, and no doubt will. But it's interesting, the ECB president, Madame Lagarde, did mention the value of the euro. So this is not just an Asian problem, though it's worse in Asia. And clearly the fact that Yellen has had to step in and show that the dollar strength is a problem, I think is the first and about time recognition of this. I think the dollar strength has gone too far. I think Yellen's admitting that. And the fact that both the Bank of Japan and probably Korea will at some point intervene. If the Fed comes along and does it with them, which is a possibility now that Yellen has mentioned that she thinks there is, some issues here, then maybe we will see, what at the moment is a bit of an overrun. It's not a crisis. We're just getting, it's a little bit painful, too painful perhaps, particularly in Asia. And, the ECB wants to cut interest rates. What's possibly holding them back, or the amount they do cut, would be if the euro dropped to parity with the dollar. So it's not helping anyone, including the US, that the dollar is this strong.
To both of you, but maybe, John, you can kick us off. Is it really, I know this is where we are, and actually the inflation picture is so different in the UK and Europe than the Fed, but there's still the gravitational pull of the Fed. So I don't know how easy it's going to be to pull off to have an ECB go first in terms of cutting and then a BOE second.
Yeah, definitely. And I also think the dollar is that's the main part of this, because the Bank of England and the ECB will be worried that obviously they'll stoke inflation because strong dollar drives up kind of import prices, and the UK in particular, we're very dependent on energy imports, and the last thing you want to see is the petrol price going up, because that feeds through practically immediately into the inflation figures. So if nothing else, it looks bad. I think the fact that Yellen obviously has recognised that this is a problem and is basically given the green light to a weaker dollar policy, and she's going to be aware. I mean, this is really important for the US election. A stronger dollar means weaker asset markets, which means everyone feels poorer. Yeah. They don't want that going into the US election, so I would think they'll find a solution somehow.
So interesting. Thank you so much, both of you, for joining us, John Stepek and Marcus Ashworth. Now, be sure to subscribe to Bloomberg's In the City podcast that I host with David Merritt and Allegra Stratton on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Now, coming up, as luxury faces a slowdown globally, we'll discuss the outlook for Britain's luxury sector. That's next, and this is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
So it's shaping up to be a year of changing fortunes for luxury. The European luxury industry faces a significant first quarter slowdown. Here in the UK, a difficult economic outlook, Brexit, as well as a loss of tax-free shopping for visitors to Britain add to the challenges. Now, a new study has shown the UK luxury sector actually contributes £81 billion a year to the UK economy, supporting almost 500,000 jobs. Now, the research has also found that the luxury sector's economic contribution to Britain has grown 69% over 5 years. The study was carried out by Walpole, the official industry body for UK luxury. Well, joining us now is Helen Brocklebank, the chief executive of Walpole. Helen, thank you so much for joining us. I mean, this is a widely exciting industry because it has grown so much, and I wonder whether you feel it's gotten the proper support from government.
I personally don't think it has, because if we were in France or in Italy, we would be garlanding this sector with laurel wreaths galore. I mean, we think about LVMH was last year the first $500 billion business this continent has ever had. So I think that 81 billion pounds and nearly 500,000 jobs says that this is the great economic powerhouse the government doesn't realise it has, and we've got to change that.
So what would you do what do you need from government that would actually help you? I know there's been a lot, and we saw the Burberry chairman just last year also stand up in a room full of, I think 600 people saying, we need those VAT refunds, otherwise you miss out people coming here and spending and shopping.
Well, 4.5 years on tax-free, the lack of tax-free shopping continues to be a thorn in the side of every business that's connected, not just retail, but the whole ecosystem, because it means that we are reducing our competitiveness with our nearest neighbour. So we're very close to Paris and Milan, and it's an international audience. Why are we not fighting on a level playing field and just offering the same things? It also affects foreign direct investment, which is very, very dependent on the allure of British luxury. So let's change that. The other big ask from us is about geographical indication status. So this suit is made with Savile Row bespoke tailoring skills. This is from our textile industry in Scotland. We have incredible regional clusters of employment. If we had geographical indication status over and above, agri-foods, whiskies, etc., we could really protect those skills and protect those 500,000 British jobs.
And we have seen, Helen, a couple of brands actually go in there and trying to take care of the savoir-faire, the manufacturing that the UK has been so good at. What else do you need? Is it, investment money coming in at a certain stage when a luxury company starts out, or is it support at a later stage when they're bigger?
I think it's a bit of both. I think first of all you need the recognition that we've been asking for, and that really that does start a lot with protecting the skills that really make sure that we've got that savoir-faire here in the UK, and as far up to the Highlands and Islands of Scotland and down to Cornwall, we're really delivering that beautiful made in Britain thing. I think from an investment point of view, these businesses are, like Church's Shoes in Northampton is owned by Prada, Belmond, an incredible British hotel group owned by LVMH, so they're very good at direct investment. But I think recognising that these businesses grow slowly but are super resilient, deliver value over time, is our message to investors.
Is it more difficult now with supply chains? I mean, again, luxury has had a little bit of a boom. I don't know whether it's post-COVID, but people were treating themselves. People wanted to buy luxurious things. We could see now a bit of a downturn, also at a moment where there's less multilateralism. So how is it tough out there at the moment for the luxury sector?
We're seeing very much a normalisation, and I think those LVMH figures of looking at 2% growth is an interesting sign. So, but off the back of an enormous post-COVID boom. But in the UK, our sector is really, really broad. So it's a very resilient sector. The great unsung hero of British luxury is the automotive. So Rolls-Royce, Aston Martin, Bentley, iconic things. And actually, that's a sector that's doing incredibly well, as is whiskies, huge export. So our risk is spread very, very wide here in the UK, a unique factor of this economy.
What do you think will make the difference compared to other luxury markets in 2 to 3 years? I mean, also as you say, whiskies, but also a lot of the apparel that men have are maybe other, things that other countries are less focused on.
We have an incredible strength in menswear. You think about brands like Dunhill, and also I've mentioned Savile Row Tailoring and the Northamptonshire shoe hub. So I think it's really about protection and recognition, and making sure that we've got access to international markets. Yeah. The sectors deliver. In the UK, we have £56 billion pounds worth of exports, and that's important because every time you're you're buying a Burberry trench coat or a Church's shoes in the Middle East or in America, you're really supporting British jobs, but you're taking a bit of British quality out to the rest of the world.
I mean, we also are in an election year where Labour is very much ahead in the polls. Have you had any reassurances from them that actually they will support your industry?
I think there is a recognition there that the export is such a strength of the sector. And to recognise that 56 billion, but the fact that it also supports those jobs. But it's a crucial time for us to do this research, just putting that nearly 500,000 jobs on show, so that we really see why luxury really matters.
Helen, thank you so much for joining us.
Thank you so much.
Brocklebank, the Chief Executive of Walpole. Now, another reminder to subscribe also to our podcast, In the City. There's another episode out today. We'll have plenty more on markets. We'll have plenty more on the UK and what we heard from Andrew Bailey, the Governor of the Bank of England. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges.
Next. It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
good morning from our world headquarters in New York. I'm Manus Granny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Authorities push back against a stronger dollar while more Fed officials signal a delay to rate cuts.
Chip stocks drop into correction as Netflix takes the earnings spotlight later today.
And Norway's sovereign wealth fund misses its benchmark on weak results in real estate. We speak to the fund's deputy CEO. A very good morning, but they did splendidly when it came to equities, a bit like everybody else. They've weathered that storm. We'll dig into those numbers in just a moment. Now, we have bounced in these equity markets. The first gain in 5 days, Danny. So we'll take that as a win. You had the longest slide since January. Max Kettner over at HSBC say that they have gone to overweight equities. This drop in equities for them will be something of a temporary phenomena. Keep an eye on TSMC, the first profit in a year after the assault that came on chips and semiconductors yesterday, with the chips moving into correction. TSMC nicely bid this morning, up 0.6%. I love what Nomura had to say about markets generally. This is not a crash down. It's just that we have got stretched positioning. The Nasdaq up 0.6% today. It's going to be Netflix, Blackstone, and L'Oreal. We're going to catch up with Wedbush Securities. What happens next to Tesla? Asian stocks are up by 0.5% because they have more or less had verbal tripartite intervention unleashed from Yellen, South Korea, and Japan. What does that mean for the FX markets at the moment? It's a good shot in the arm for equities. Danny, good morning.
Good morning, Manus. Finally, there is a bid into bonds. Finally, yields are high and juicy enough for people to jump in. Even the 20-year bond auction yesterday, a 10-year that's usually very unloved, second strongest demand since it was released in 2020. Really remarkable. So we move lower again in yields, nearly 2 basis points. We're still above 4.5%. But this is a rally that we haven't seen in quite some time after a 40 basis point move higher in yields. So maybe it is the juicy yield. Certainly doesn't seem to be geopolitics or a haven bid because oil has been moving lower. We're down 0.7% despite the fact that there's still uncertainty in how Israel will respond to the weekend, to Iran's attack on Israel. We're back to trading on fundamentals. U.S. stockpiles climbing, hence Brent crude drops lower. We're below $87 a barrel. Manus, you mentioned this trilateral intervention. Is that what is on the cards? We heard from Conda from the Ministry of Finance saying, as he usually does, that they're looking at FX moves. It is a harm to the economy. But what's different this time is that Yellen held a joint press conference with not just Japan, but South Korea too. Does this mean intervention is on the way? But Manus, how will that stick? Because the dollar has been dominating as we have this reappraisal of what the Fed is going to be doing.
Yeah, well, just bear in mind that when it comes to this whole narrative around intervention, back in 2019, China was labeled an FX manipulator. And guess who was on that list as well by the United States of America? It was Japan, followed by South Korea. We're at the top of those lists of currency manipulators. Far be it from me to say that politics plays a very important. This is about soft power of Asian reach by the United States of America, making sure that we are together, we are aligned, we are your ally. Right. That is the message when it comes to FX.
Of course, the irony is stronger dollar helps with inflation, and the U.S. still has an inflation problem. So they don't want to let it weaken too significantly, but maybe tilt to the hat to Japan and Korea to allow them to jump in and do intervention.
Okay, well, we're going to see how that plays out because dollar yen's not exactly shaken up by the whole thing at the moment. So let's see where the money moves to putting the money on the table. Now, we've had the Norwegian Sovereign Wealth Fund underperforming its benchmark for the first quarter, with returns coming in short for second consecutive quarter in a row. Trond Grande is the Deputy CEO and the Chief of Staff at Norges Bank Investment Management. He joins Danny and I this morning. Good to see you this morning, sir. So this is the second quarter of underperformance. And if we can just split it down in terms of the areas. Obviously, equities very well done. Fixed income and real estate, perhaps a little bit more of a drag. I want to focus on fixed income, first of all. Where were your biggest losses in fixed income? And everybody's struggling with this. When you see this yield spike, is this the top of the repricing in the bond market? Are you inclined now to take advantage of higher yields to add duration?
Well, thanks for having me on. So, you know, we are a long-term investor. We are investing in global equities and global fixed income, 70% equities, 30% bonds. And so it's important for us what happens in the interest rate market. Of course, we've seen the rise last year up to 5% on the 10-year treasuries, down to below 4% and now picking up again. So that will have a mark-to-market effect on our portfolio, but we're not overly concerned about that. I mean, we are, as a long-term savings vehicle, it's better for us that interest rates are high, essentially.
Right. And in that, Trond, because the market has done something which you all over at Norges Bank have been talking about anyway, that we had kind of a ridiculous amounts of cuts priced into this market, and they had to go, and that's what the market is working through and digesting. Do you think the worst of the bond tantrum is now over? Have we finished that digestion and pricing out of cuts?
Well, it's hard to say, right? It's changed remarkably in a rather short period of time. I mean, going into this year, we had an expectation of, what was it, 6 cuts from the Fed this year, and we're now down to 2 or even below 2. So who knows what's going to happen, right? And inflation has proven to be a little bit more sticky maybe than people anticipated, and the Fed has said that they will be looking at the data, the hard data, and be data-driven in their decision making. So we'll have to see.
How important is it, John, that the next move is a cut? I mean, there's this conversation now rising that the next move could be a hike, and some people have sort of said, look, it is critically important that they put some kind of a cut in because it signals the trajectory of travel. How important is that for markets and risk that the Fed does begin to cut?
It's a good question, right? Because what we saw in the last 2 months of 23 was a really strong equity market rally, and I would say that was mostly on the back of falling rates. Now, the surprise this year has been, at least in the first quarter, has been the continuation of this bull market, but at the same time, rates going up again. So there seems to be a little bit of going 2 ways there, and I think increasingly for the equity market, at least, it's going to be the proof of the pudding is going to be the earnings and the earnings season. If they hold up to the expectations,
and Trond, we'll go back to equities in a moment, but if we are in this environment where rates are going up again, that's obviously not good for real estate. I know you're a long-term investor, and this has been a thorn in your side, but the real estate issues are one of long-term, because you're going to have maturities coming due, not necessarily this year, but years to come. So as one private equity executive put it to me yesterday, this is a slow-moving train wreck, something that will take 5 years to unfold, so the pain in real estate to really manifest itself. Would you agree with that?
Well, so we have a mandate to invest up to 7% of the fund directly into unlisted real estate, and we're currently just at 2%. And so you're correct, you know, it has been a tough 24, 36 months even. But our opinion is that, you know, these investments are looking increasingly attractive. We're not running we're essentially running no leverage on our real estate. So we will be in a position to actually pick up potentially some good investments in this market environment, even now or going forward a couple of years.
And in that area, Trond, where do you want to be exposed? I had HSBC with us saying, look, the worst is past within commercial real estate. If you are prepared to pick up opportunities, where do you see those opportunities?
Well, I think you can see them more or less all over, but it's a very different kind of play. You see new emerging sectors like data centers, life sciences buildings, and those things, which are, you know, long-term attractive investments. I think they're a little bit so far not core to our strategy. Our core strategy has been commercial real estate, you know, office sector and retail, and we will be looking at good opportunities in that space, certainly.
Trond, you mentioned the resilience of equities, certainly the resilience of tech, which you mentioned in the release of this results, that it was tech that really helped to lift the overall boat. Last time the CEO of Norges Bank Investment Management was on, he said that it was an equal weight allocation to tech. Given the resilience of it, given the AI narrative, which continues to move higher, what would take you to move from an equal weight to bring more on board?
Well, I think we've been in a position like that for quite a while now. So this is a super big sector. It has become the biggest sector of our investment portfolio, but it's also a very expensive market, or if not very expensive, it's pretty highly priced. So that's why we're being a little bit careful. I mean, there's a lot of merit to the enthusiasm surrounding AI, certainly in the hardware space, but so far, you know, it's to be proven how you can monetize it also in the software space. But of course, there's a lot of gains priced into the stocks of Microsoft and Meta on the basis of this. So we're just staying a little bit careful.
Is it time to be cautious? Do you think that this is a very overly concentrated and crowded, not so much trade? I know that you are a long-term investor, but when you see the herding that is going into this area, do you think it's overcrowded? Is there a bigger risk in stepping into this sector right now?
Hard to say, but you know, the mere facts is that it has been much more concentrated bet. The Magnificent Seven, if they're still called that, make up like 14% of our equity investment, and that is a huge concentration. So obviously a case to watch out for, because we want to have a diversified risk taking and a diversified portfolio that we can that can be resilient in tougher markets as well.
Yeah, resilience, the name of the game. Trond, we're going to have to end it there. Thank you so much, Trond Grande of Norges Bank Investment Management. Okay, let's get to some of the other top stories that are trending on the terminal this morning. Donald Trump's advisors are pushing to keep a cap on the state and local tax deduction. Economists Stephen Moore and Arthur Laffer say that they are opposed to any increase to the $10,000 write-off cap on salt. That limit was imposed on Trump's 2017 tax law and will expire at the end of 2025.
Elon Musk says some of the severance packages sent to the former Tesla employees as part of the biggest ever workforce reduction were too low. In an email, Musk apologized for the mistake and said it's being corrected immediately. Earlier this week, he announced Tesla would slash the global headcount by more than 10% as the car maker struggles with slowing demand for electric vehicles.
Micron is poised to get $6.1 billion in grants from the Commerce Department to help pay for domestic factory projects. According to sources, Micron, like Intel and TSMC, will also accept loans as part of the package. The plans are part of a U.S. effort to bring semiconductor production back to American soil.
Well, global chip maker TSMC delivered a better than projected revenue outlook and stuck with the plans to spend more than $32 billion in 2024. The forecast followed its first quarterly profit rise in a year. That's after strong AI demand revived growth at Asia's biggest company. Coming up this hour, chip stocks enter correction territory. We await more tech results. Dan Ives from Wedbush Securities joins Danny and I shortly.
But first, up ahead, UBS gears up for, another round of job cuts. We're going to have more on that next on Bloomberg Brief.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now. We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. UBS plans to cut 100 positions across its investment banking unit as the firm continues its cost-saving efforts. For more, let's get over to Bloomberg's Jeff Black, who joins us now from Zurich. Jeff, it's yet another round, and it does feel like executives at UBS have little appetite for anyone who's left from Credit Suisse. So how does this fit in to the overall job reductions we've already seen?
Good morning. Yeah, you're right. There is a pretty constant trimming of positions going on at the investment bank and elsewhere. We had some quite senior ones in January, mainly in the US. Last month, we saw about 90 in Asia, also in wealth management, going. So it's important to bear in mind the destination here, which is that UBS wants to cut the Credit Suisse investment bank by about 2/3, and then integrate what it wants from that into its own and move forward.
Jeff, good to see you this morning. I mean, if you look at some of the numbers laid out in this story, Credit Suisse was inherited, 45,000 extra people, taking the total global workforce to 120,000. There is a lot of duplication, even at IB and WM. There is duplication geographically. Do we have any clearer sense the broader integration of Credit Suisse into UBS, the time it's going to take to unwind a lot of that duplication and the technology overlay?
Yeah, well, we've already seen that headcount. So you mentioned the 120,000 figure. That was down to about 113,000 at the end of the last quarter. So that's already, proceeding at pace. A lot of the duplication that's intended to be stripped out is in the investment bank. And the UBS CEO, Ermotti, has already indicated in what way he wants that to go. So it's technology, private equity, it's telecoms. These are the sectors that he's interested in building up. And anything that's outside of that, so the riskier trading, derivatives, those types of activities, that's pretty clear that that's in for a serious trimming. The overall strategy, as I'm sure you're aware, is that UBS wants to be the world's largest wealth manager. So everything that happens at the investment bank has to fit that goal.
Right. And I mean, now, as Colm Kelleher said, 2024 is going to be the most difficult year for integration. On top of that, Manus and I talked about earlier this week how Swiss regulators are looking at imposing a potential of up to $20 billion capital requirement onto UBS. So put all of this difficulty in context for them. What is the plan? You mentioned some of it, but what is the plan for Colm Kelleher, for Sergio Ermotti to get UBS through what they've called the most difficult year for them?
So they've got to get through the nitty-gritty of the integration, and a lot of that is things like merging IT systems, getting through job losses, figuring out how they're going to merge the operations in Switzerland. That's got a lot of potential for losses that have to be taken up front. So this year might be a bit difficult from that point of view. We've got earnings coming up on May 7th. But if they can get through this year still intact, then the focus turns to growth. And for investors, the capital returns that they're going to be getting from the new group, also in mind that Switzerland wants higher capital requirements.
Well, yep, that's the understatement so far of quarter two, isn't it, Jeff? Switzerland want a little bit more capital requirements, somewhere between 15 and 25 billion Swiss francs. Jeff, thank you very much. Let's see how that capital requirement plays out in Bahnhofstrasse in Zurich with the very latest on UBS. Jeff, thank you very much. Quick snapshot of what's going on in the bond market, Danny. Yields ticking down ever so slightly, down a tick. You'd hardly call that a move. I mean, there was a nice 20-year auction yesterday in the United States. It was well bid. Beige book, moderating wage pressure. Again, it's not, you're right, it's sort of more meh.
But we never care about the beige book. Is that sacrilegious to say?
I don't know. You've just cut me down in flames. There you go. I don't know. It was written up as being the moderating wage pressures, and I think that's what people are focused on.
Yeah, sure.
Any nuance on wages, and that plays to PCE.
But part of this is also just, yields are at really juicy levels. We felt 8 basis points yesterday, and Manus, I do think, as you say, the 20-year bond auction is notable. This is usually an auction that doesn't go well. This is usually a tenor that people don't care about. This was the second strongest demand for this bond auction since it returned in 2020. I think that's really saying something. Yields look good and people want to jump in.
Well, we just had that conversation with Norges Bank, and in terms of them, they're long-term players, but that's where they took their point of pain. But so did everybody take their pain in the bond market. The question is, does real money come in on 10s, 20s, and 30s? Citigroup say you are wrong to think it's only 2 cuts. Folly you, 125 basis points, Citi are still in there.
Yeah, the question is the bond turmoil over? Do we have still more cuts to price out? A lot of questions, and we'll have more of them here on Bloomberg Brief.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg Brief. I'm Manus Crenny alongside Danny Berger in New York. Now, Are you ready for Japan, South Korea, and the United States? A tripartite agreement to watch the FX markets really closely. This is what we understand. There was a statement signed by Yellen along with her cohorts from Japan and South Korea, and essentially it was, we're watching the FX markets, but this is about politics as well as FX, which is the US reaching across and saying, look, we're with you to the Asian currencies, which have been demolished this year.
Right, I mean, it's written up as a nod, basically saying we understand and we sympathize with the weakness in your currencies. That is her implicitly saying the US will be okay if you intervene in your currencies. That's not necessarily a trilateral intervention, but it opens the door to it. Now, it is notable, though, that the market has not responded to it. You can see the yen there.
Yeah, you've decided now it's not responded.
No, but the truth of the matter is...
Minutes ago you were saying it was...
...is that traders aren't nervous because they don't think that it can possibly alter the outlook for the yen.
The view in FX markets is that unilateral intervention in of itself, whether it's verbal or whether it's with cash, does not do the job. And Jane Foley's going to be with us on Monday, but she sent us this. Remember 2019, it was the US that put Japan, South Korea underneath China on their watch list. So this is about politics as well. And you're going to need, rate differentials are absolutely going to hold firm for dollar yen.
Yeah.
So you're going to need some radical shake up there before you get a move.
Yeah, it could also just be fatigue. I mean, how many times have we heard from Japan in terms of we're watching the currency, we're concerned about the currency weakness? It could be down to that too.
Could indeed. We're going to talk a little bit more about markets and how brave you feel. We've got Michael Purvis from Tolbakken Capital in the studio.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses with the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Month low, the chips went into a correction. TSMC came out and said, actually, we've got our first profit rise in a year. We just caught up with the Sovereign Wealth Fund of Norway. Of course, they have a high commitment in the AI space, and they are committed to that in terms of real estate. Also, they're going to see opportunities. When there are opportunities in commercial real estate, they're going to jump into that. S&P 500, you've got HSBC moving to an overweight on equities. The drop in equities for them will be short-term. Nomura say this, that these equity markets which have dropped, it's not a crash down, it's merely stretched positioning. And again, that was reconfirmed by the conversation with Norges Bank as well. Today, Netflix, Blackstone and L'Oreal deliver. I popped the Asian markets up there because there is this response mechanism, not only in the currencies, but also in the equity side as well, on this tripartite intervention statement from the US. It's not a statement on intervention, but it's almost a tacit nod by the US to Korea and to Japan. Should they wish to step in, they have the free rein to possibly do that. Danny.
So I didn't want to talk too much about the yen because I wanted to leave it to you, Manus. It was my gift. That's what that was. No, but on this idea, as we were talking about the deputy CEO of Norges Bank, that he likes tech, but he doesn't want to get more into it because it's too expensive. A lot of folks feel that way, but that doesn't hold them back. The latest fund manager survey from Bank of America, their title, which I know you'll like, was Pretty Fully Bully. It was the most bullish fund manager survey since January 2022. They say, look, the bullish sentiment is not quite close your eyes and sell, but it poses a real issue for risk assets because we're more vulnerable to bad news than we are good news right now.
Yeah, but we see that. We see that on a daily basis. As soon as there's anything askew in any of these tech, Mag 6, Mag 7, we'll talk more about Tesla a little bit later on, but the slightest hint of disruption in the narrative, and there is an immediate puncturing of risk.
No, really well put. Now, our next guest talks about that as well. He writes that we continue to think we're in for consolidation and perhaps something more painful. It's time for thoughtful defense. Joining us now is the ever thoughtful Michael Purvis, CEO and founder of Talbot and Capital Advisors. Michael, great to see you. Thanks for coming in so early this morning.
Good morning.
Look, in a world where both equities and bonds continue to sell off in tandem, what is thoughtful defense?
Well, I think right now you have to think about just within the equity book, right? We've seen a situation where whatever sell-offs we've had have been really kind of driven a little bit more by, as you were just saying, you know, like, oh, is the story off? Like Tesla, for example, right? There, I think what could happen here, and again, broadly speaking, I've been very constructive for a while now on the economy. I think it's going to be rate resistant to a largely speaking and so forth. But we are, I think, due for a consolidation. I'll get into that in a little bit there. But, you know, you asked the question about defense there. Look, I think right now you got to think about if you are going to just de-risk, simply going to cash. Like near-term bills are still paying a really, you know, it's still not a bad place to park, right? If you're getting 5% on your cash there. So I think that's sort of an obvious thing. And I've been advocating for, you know, getting long VIX through VIX calls for some time. The VIX has come up here. We are getting into a more robust cross-asset volatility picture from, Treasury vol to equity vol to oil vol, gold vol, and so forth.
Is it too late to hedge?
Well, yeah, it's not as good as it was back when the VIX was.
Or maybe the
back
type
at
of question
13.
is it too late to hedge? And if you were going to hedge, what would you use?
Well, I think you have to be always careful with hedging with options when when vol has been pushed up here, right?
Yeah.
You can lose money on premium pretty quickly here. And when I'm saying defense, look, I'm not talking about some massive sell-off here. I'm talking, like I think there could be further downside, an overdue sort of, late winter hangover, I call it. That's, maybe down to 4,800 on the S&P 500 there, right? So that kind of thing. I'm not talking about 4,300 or 4,000. I'm not talking about like head for the hills apocalypse.
So what do you? Well,
I don't have another apocalypse left in me, so I'll be grateful for 4,800. Thank you very much.
Apocalypses in our lifetime. Okay, so if we are heading down, is that a just buy every dip kind of?
Well, yeah, I think look, my view on like how thinking about buying the dip, and look, we are just getting going on the earnings season here, but we're in a situation where it's really about if the stock's going to generate earnings above expectations, or you think it's going to be generating earnings above expectations, that's and the earnings are there, that's going to stock's going to get bought, and more so during the dip. I think if we, we had some geopolitical jitters over the weekend, and if those were to resume, and we got more of that pan-asset de-risking where the VIX is at 30, that's where you're going to see the winners indiscriminately get sold more so than the laggards there, right? So, if I look, you mentioned Mag 6 there. The Mag 6 was up, at least through Friday, was up about 22% year to date. Compare that with the SPX equal weight, it was at the time was up 4% year to date. The fundamentals, I would argue, are better for the Mag 6 than they were for the SPX equal weight, just simply that the earnings growth was 18% for the Mag 6 from the beginning of the year. That's very impressive, right? And I'm like, follow the earnings. But the caveat to that is that if we get just indiscriminate selling, what went up the most will get sold the most, right? And we haven't seen that in quite some time.
And I think that goes back to what Nomura was saying, which this is not a crash down. This is just stretched positioning, and stretched positioning in nervous geopolitical times can be pressed. I'm just looking at the oil price at this morning. There's a couple of interesting things going on in oil. Gas demand has taken a bath. You're also seeing cushion inventories. Let me just get the right facts. I'm just curious in terms of what you think. Fuel demand, this really shocked me. Fuel demand in this country is the lowest since 1999. Inventories at Cushing are at the highest levels since June. I was actually really, really shocked when I read those numbers. But you look at the oil market up 14% and change here in the United States of America. Where is that most injurious? To Biden in the polls in gas, or in the Fed's complex for inflation?
Or all of the above. I mean, look, I think, look, we have had an oil sell-off. There was a geopolitical premium that was maybe, in hindsight, overpriced here, and you come into those inventory numbers you were just describing there. But look, I think there is a broader story here that there was a quiet rally in crude from $67 up into the the middle 80s here, and if you look at, Powell bottom ticked crude in that December FOMC meeting, right? I mean, there was that Q4 feeling of disinflation is here, rah, 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 we're getting to 2%, all's good. And here we are, the summer drives around the corner. We have the SPR, it's not filled up, right? It's still at especially low levels. There, and there is really a potential for oil to rise higher. Now, just speaking, getting back to that cross-asset sort of condition for a second, the thing I've been concerned about is if you remember the Treasury sell-off back in September and October, that was really driven a lot by term premium. It really wasn't about hikes. It really wasn't about commodities rallying. It was about term premium. This time around, it's been really coinciding with higher copper prices, higher gasoline prices, oil prices, and so forth. And of course, other things have been upside surprises on the inflation side. But what if oil does pop back another $10 or $15, $20 in Q2, and that re-aggravates the Treasury sell-off there? And that, to me, is how you you might get that 10-year back to that 5% level, and that's how you might get that scary pan-asset risk. I'm not predicting it. I'm just saying this is a risk I'm very focused on.
Right. Well, that risk also ties into this idea that the volatility we've seen as of late is across asset volatility. Right. It's not necessarily confined to one sector. But as I say that, I mean, the VIX, sure, it popped over the past week, but it's still below 20.
Yep.
So when you're talking about cross-asset volatility picking up, if it is more highly correlated, if it's oil, treasuries, and the VIX, is this a regime shift, finally, that takes volatility to the highs that it used to trade at when we were nervous in this market?
Well, look, you know, I think that's a great point, a great question. I do think the VIX is going to normalize to a higher level. If you go back to the late 1990s, you had a great equity market, right? And the VIX averaged considerably higher. I think the average VIX for the last 3 years of the 90s was around 20 or so, right? We've been used to thinking about bull equity markets back in, you know, the 2010 to 2019 period with like a super low VIX, right? But equities can rally with a higher VIX. And I do think if you're going back to a more earnings-driven equity condition, that will come inherently with a higher VIX there, than as opposed to, oh, my God, the Fed's easing, so we have to get, you know, sell vol, right?
I think she's just secretly writing put options out there. So
I don't think I'm allowed to do that.
I don't think she's allowed to do that. I don't think any of us are allowed to do that. But you're right. Equities can survive in a higher volatility regime, and it's just understanding and getting used to that. And I think we slowly are. Or maybe I'm overstating it. Michael, thank you very much for being with us this morning. Our guest this morning on markets, that is Michael Purvis of Tallbach and Capital Advisors. Coming up in the show, Danny and I, we're going to catch up with Dan Ives on Wedbush. Mag 6, Mag 7. What does he really think about Tesla?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
There's a lot of merit to the enthusiasm surrounding AI, certainly in the hardware space, but so far, you know, it's to be proven how you can monetize it also in the software space.
That's Trond Grande, Deputy CEO at Norway's Wealth Fund, speaking to Danny and myself just a little bit earlier on their tech exposure. Well, the chip market, including NVIDIA, entered a technical correction, raising concerns whether the rest of the tech markets will follow suit. Dan Ives is with us from Wedbush Security. Dan, good morning. Good to see you.
Great to be here.
Volatility. I mean, you've got to be sort of kind of brave to hang on to the desk and sort of go, whoa! It's like a roller coaster ride with NVIDIA, with chips, ASML. I mean, different bombs drop in this technology sector. How stoic do you need to be? How much do I need to believe that the earnings will trump emotional volatility in this market? Good morning.
Great to be. Yeah, I mean, like, look, it comes down to earnings. And I think the next few weeks, this is a get out the popcorn moment for tech. And you're going to see chips, AI revolution, enterprise, consumer on the digital side, I think Google, Meta, and others. I think this is really going to be a flex the muscles moment for tech. So my view is, no doubt, white knuckles, many yelling fire in a crowded theater on tech. I think we sit here 4 or 6 weeks from now, look at this more of a golden buying opportunity rather than the time that was something more structural.
And you think the earnings are going to show up, and I got to say, given that NVIDIA is 11.5% lower for the top, I mean, if you are bullish on tech and you're expecting earnings to turn out, this seems like an incredible opportunity.
Look, our view, and over, whatever, 25 years, hand-holding, it's through the choppiness and the volatility. That's why all the work we do traveling around the world, in Asia, understanding what the supply chain looks like, what demand is. And I think, look, a few quarters ago, it was choppier in terms of enterprise and what we saw in terms of overall spending. But now, the monetization of that AI revolution, it's happening. And it's not just about Godfather of AI, Jensen and NVIDIA, and of course what Redmond and Nadella are doing. Now it's everyone else. You look at what's going to be happening with Palantir, Google, Amazon. I think the rest of the software names like MongoDB, Salesforce, and others.
I love what you wrote about Microsoft. It's the iPhone moment for Microsoft. I mean, that's tantalizing. So just build on that narrative for us.
I mean, for Microsoft, when Nadella is done, we're talking Mount Rushmore, Hall of Fame, and they're building a statue of him right now, Redmond, because when it comes to AI, OpenAI, and you look at Copilot, this is really the start of the next growth story at Microsoft. Look, we think from all of our checks, for every $100 of spending...
Have they got a moat? Are they so far ahead? Have they got a barrier to entry against everybody else?
It's like Mahomes as a quarterback versus everyone else in terms of NFL. And what you really have here is that Microsoft is the top of that mountain. Google, they're going to gain share. Amazon, this is not a zero-sum game. So you're going to have what we've used $1 trillion of spend over the next decade. And Danny, it speaks to my point. It's very easy in these near-term periods to be like, that's it, tech, it's expensive. But it goes back to expensive. I'll pay up for the Bugatti in the left lane rather than in the minivan that needs a paint job with no radio in the right lane going 30 miles an hour.
I really wish we had a camera on Manus's face when you mentioned Patrick Mahomes. I really wish we did. It's because it's Manus's favorite team. He's a big fan of the Chiefs.
It's called a cultural curve, isn't it?
Yeah, he'll get there. We'll get him sped up, Dan. I mean, but look, we are in this moment. I was saying this during the break, is I feel schizophrenic that every day I look at NVIDIA and say, wow, it's holding up really well as yields are going higher. And then the next day I'm thinking, wow, NVIDIA, we're finally selling it. Does it seem, though, that there's been a sentiment shift on the overall investor and the willingness to hold their nose and buy NVIDIA? And for you, is that maybe even a good thing?
Yeah, look, and you talk about, a great job in the show in terms of the 10-year, 5%, that hurts tech. It's almost a Groundhog Day 2022. But this is different because of ultimately, if you look at the growth in tech, unless you have a telescope, it's hard to find the recession. And when you look at what's happened from an AI perspective, this is a fourth industrial revolution that's happened right now, a 1995 moment. I'm not saying we're not going to have pullbacks, especially Fed speak, everything we're seeing, cuts. But at the end of the day in tech, if you're able to see forest through the trees, that's really where the money's been made in tech, rather than, look, right now, New York City cab drivers bearish and some of these high growth names going into earnings.
You say that the spend in information technology, in AI, will be around 8 to 10%. So you say that AI and related purchases will comprise 8 to 10% of IT budgets. So if you're not in NVIDIA, if you're not in Broadcom, I mean, maybe you should have obviously an allocation to them, but where's the breadth in tech? We talk about breadth in markets, reaching for breadth in markets, but where is a better breadth play in tech outside Mag 7?
Well, I think it's in software. Right now, the baton is being handed from semis to software. Because if you look, the use cases, Salesforce, ServiceNow, Oracle, Microsoft. If someone told you 6 months ago Dell was going to be an AI play, they say, ooh, I want what he's having or she's having. So the point is, when you now start to see...
That's a bit harsh on Dell, is it?
But you start to see what's happening now with AI. It's not just about Godfather of AI, Jensen, NVIDIA, and Microsoft. We're spreading the monetization. That tidal wave's coming to tech. And I get it. If you want to sell tech because 10-year goes up 50 bips, that's the nature of the beast. But it goes back to this is what I view as a 1995 moment, not a 1999 moment.
And a clear difference between the two. If you're looking to bet on AI as a long-term, one company in particular that's been thrown into question recently is Tesla, with Elon Musk essentially saying, either give me this pay package or I take my AI elsewhere. What do you do with that, Dan?
Well, if you looked up disaster in the dictionary right now, you'd see Tesla the last 3 to 4 months. Because look, you need an adult in the room. And for Musk, we could talk pay packages, the Delaware comp issue. We're talking about train wreck deliveries, and what's really been mixed messages in terms of I'll take my AI elsewhere, Model 2, that's a key part, that's a key part of the growth story for the next few years. Next week, we're talking about a moment of truth for Musk and Tesla, with patience wearing extremely thin here.
You say that the clock has struck midnight for Musk to lay out a growth strategy and give realistic delivery and margin goals. That's essentially what you have said. To discuss why significant layoffs now, and most importantly, give a clear outlook to the street around Model 2. Now, we were in makeup this morning. That's the kind of way that we roll on the 5 a.m. It takes a lot of work to get this truck on the road in the morning. Just describe to me what is at play with Model 2 if it's ditched.
It changes the growth story. It historically would change the growth story. Now, everyone will be like, autonomy, robotaxis 5-6 years from now. We're talking right now, you're at the edge of a cliff. It's for Musk to bring it back, fork in the road, navigate through this Category 5 storm. If you all say robotaxis, 5-year, the cult crew, everyone, that's what they're focused on, you ditch Model 2, this would be a historic disaster gamble that could change the future of Tesla in terms of dark days ahead. And that's why this is really, this white knuckle pair, clock struck midnight, fork in the road, it's next Tuesday.
Well, Dan, you got an outperform still on Tesla. Would you change it?
Longer term, we're bullish in terms of the Tesla story. But as we've talked about, this is the period for Musk. Lay it out, don't just talk, walk the walk. Because the benefit of the doubt's not there, and this has gone from a Cinderella story to essentially a Friday the 13th.
Well, that's the note we're going to end it on. A brutal note.
Uplifting thought. It's gone from Cinderella to what? Friday the 13th?
Friday the 13th.
Well, Nightmare on Elm Street. Pick your...
Put it on a T-shirt. Put it on a T-shirt. Dan, thank you so much for joining us. We really always appreciate it. Dan Ives of Wedbush. Okay, coming up, more Fed Speak and Netflix. All of that on deck.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges. Britain's next.
Was going to keep reading
World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This is Bloomberg.
It's your Bloomberg Brief with Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day. We're going to have a slew of economic data. Initial jobless claims come out at 8:30 a.m. Eastern. Existing home sales at 10 a.m. Then more Fed speak. John Williams, Michelle Bowman, Raphael Bostic all throughout the day. Then after the bell, Manus, it's Netflix up to report earnings.
Yeah, I'm sure we can almost pre-write the narrative there, which is let's wait and see, get more confidence. Micro movers for you this morning. Micron getting $6 billion, in a CHIPS Act grant next week, according to reporting by Bloomberg. NVIDIA also on the up. TSMC's outlook beating forecasts, giving AI a nice boost. There's the SPOOs at the bottom of the page. Danny, up an eighth of 1%. We're breaking 5 days of a brutal sell-off.
Yep, finally some reprieve this morning. But will it last? Bond yields also charting lower. Surveillance will take it from here. That's it for your brief.
Most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of finance, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy. It's not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The Fed keeps high for longer, then we will see that slowly wind its way through the economy.
As long as the market still believes they're about to embark on a series of rate cuts, then equities can hold in.
We will continue to see upward inflation pressure and potentially upward pressure on rates.
You still need to see this softness come through, and we're not seeing it across any of the metrics.
The longer the Fed holds at 5 and change, the risk in the equity market is actually increasing rather than going down.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro, kicking off our coverage of the IMF World Bank spring meetings. And I have to say, the two big issues in the global economy right now, the two big issues are right here in Washington, D.C. The sustainability of the deficit in the United States of America and this drift towards industrial policy. Front and center, Bramo. Every single conversation you have right now, all roads lead back to that.
Especially given the fact that it seems to be sovereign debt that's going to be the real issue, not necessarily any kind of corporate debt. When you talk about the geopolitics of the moment and the fissures between China and the U.S., it'll be fascinating to see at the IMF how that's dealt with, given the fact that China's a member of the IMF and supposedly is trying to create a global coalition. What does a global coalition look like in a fractured world?
So it's not just China and the United States. It's the United States and Japan. It's the United States and South Korea. It's the United States and India, Malaysia. You see this repeatedly in the FX market. The rupee at all-time lows. Malaysia stepping into the FX market. Japan, South Korea threatening to do the same. And what you saw take place yesterday, Anne-Marie, I thought was really interesting. A meeting between Secretary Yellen, the Japanese, and South Korea. Foreign exchange is going to become a big issue through the next couple of days.
Absolutely. And they put out this joint statement after this trilateral meeting. And this was the quote: "We will also continue to consult closely on foreign exchange market developments in line with our existing G20 commitments." It goes on to say, while acknowledging serious concerns of Japan and the Republic of Korea. It's almost an implication that the United States is aware of what Japan is dealing with and that they're okay if they're going to prepare to intervene to try to prop up their currency. Because what you started the show with is this loose fiscal policy. What does that mean in terms of a higher dollar? Okay. The rest of the world is dealing with U.S. exceptionalism.
But what could they do, right? I mean, this is essentially the policy response that is really uncertain. You have the finance minister, the currency head over at the Bank of Japan saying we're concerned that this could have a bad effect on our economy. You have Janet Yellen saying we acknowledge the worry. What are they going to do if it's just differentials in growth? And this is a factor of differentials in monetary policy that is not changing.
So the answer is nothing. So the next question has to be, for how much longer can they take it?
Yeah.
For how much longer can this go on? Because ultimately what they all want are rate cuts from the Federal Reserve. It's not just the market, the equity market and Wall Street that wants to see rate cuts from the Federal Reserve. It's the global economy and a lot of policymakers worldwide who would like to see the same thing.
Which raises this question, how much is that going to really factor into the Fed's decision making? And what happens, and this is something we were talking about yesterday, what happens if they cannot cut rates because inflation remains too high and they're going to be accused of political interference? Then do all of a sudden we see the dollar breaking things? And are we getting closer to that point?
And what you're hearing from a lot of people alongside the IMF is they need to know what is going to happen post-election. Because one thing the IMF talked about is the fact that we already have this loose fiscal policy in the United States, but they say it's even looser. They like to spend more in election years. So that means potentially the hangover after November is going to be even harder for the rest of the world.
What's it feel like to come home? Does it feel good?
Feels hot.
Have you missed Washington, D.C.? It's hotter.
It's warm in D.C.
Swampy. Let's turn to the price action. Equity futures right now on the S&P 500 shaping up as follows. On the S&P, a little bit of a bounce. We're up by about 9 points on the S&P 500. We're positive by 0.2%. Yields are lower by a single basis point, 457.31 on a US 10-year. And crude pulling back by 1%. We're back down to 81.82, Bramo. And I think if you were worried about a stronger dollar, you've had a weaker one. If you were worried about higher crude prices, they're lower. And if you're worried about higher yields as well, they've pulled back too in the last day or so.
It's a tense pause. Honestly, I can't get a lot of signal from this. We did get a 20-year auction that was better than expected yesterday in terms of how it was received. But right now, very difficult to say that there is a calm or any kind of feeling of complacency, particularly around oil. And there's a big discussion around that here at the IMF meetings. What happens if you do get a surge in prices? And you can't plan ahead for something that hasn't happened yet. And that's essentially what the market's kind of reeling around.
We'll have that discussion in just a moment. Coming up on the program, we'll catch up with Tony Dwyer of Canaccord Genuity with stocks on their worst losing streak since January. Leland Miller of China Beige Book as President Biden ramps up tensions on the campaign trail. And Tiffany Wilding of PIMCO on worries the path to 2% is starting to stall. We begin with our top story. The S&P 500 looking for its first gain in 5 days as Treasury yields continue to ease. Tony Dwyer of Canaccord Genuity saying this: we expect both the interest backdrop and EPS contribution to improve later this year, following a period of market indigestion that should relieve the historic overbought condition. Tony joins us now for more. Tony, can we talk about market indigestion? When you say market indigestion, is that a 5% move lower, a 10% move lower? What is it?
Well, John, it really depends on what you're looking at. So to me, we so focus on the S&P 500. And as you know, I stopped giving a target a while ago because I don't know how to evaluate 10 stocks, which now make up 34% of it. So could the S&P 500 go down between 5 and 10%? It could. The equal weighted S&P 500 and the Russell 2000 and the average stocks, you know, the troops versus the generals, they've already seen some pretty poor relative performance. They're actually at a cycle relative performance low, where a lot of damage has been done. So I don't think you're going to get as much pullback in the broader market, because you've already seen it, than you could in the S&P 500.
So what are you advocating for right now, Tony, given everything you've just said?
So what I missed last year, and I think what a lot of people missed, is if you remove the Magnificent Seven stocks from the S&P 500 operating earnings, according to LSEG, my earnings wizard there, TJ Dillon, you would have had a negative earnings year ex the Mag 7 for the S&P 500 operating earnings. The same is true for this quarter. So it's no surprise that you got the market concentration that you got because you had a concentration in earnings. What I'm talking about is the market indigestion is doing exactly what it's doing now. You pull back, you create fear, the S&P targets come down, people start calling for a correction, the bull-bear ratios get out of whack and get back to more normal. The overbought condition is relieved, and it sets the stage for later in the year. The higher rates are now, guys, the more likely they're going to be lower later this year, because it's going to have a dampening effect on the economy. If the lower rates and or the talking of lower rates and looser financial conditions got us into the reacceleration, won't the opposite happen, given how talking of not lower rates has tightened financial conditions? And I think that and a better earnings contribution really sets a stage for a recovery in the second half.
It's getting harder and harder, Tony, to see what happens past June. I am curious, though, what happens if the Federal Reserve cannot cut rates in June, as pretty much is consensus right now, and the ECB does cut, and the rest of the world does cut, and you start to see the dollar getting stronger and stronger. Are you worried about something breaking and this becoming less orderly than the immaculate disinflation we were talking about earlier this year?
Yeah, Lisa, I am worried about it. How can you not worry about it? You're in a levered system. You know, we have a generationally levered system when you look at debt to GDP. Every area of the universe in finance needs lower rates right now, whether it's M&A, whether it's Wall Street with capital markets, whether it's the federal government who's got to raise debt at much higher short-term rates than they have in the past. So it's a very tumultuous time, and at least that's what's showing up here. That's why the dollar is rallying. That's why the bond yields are starting to drop when you have market indigestion. You're in this situation where nobody would think about Jerome Powell at the end of the dovish pivot at the end of December last year. You know, the market's looking for 7 rate cuts. Now he's saying maybe none. So we're looking at somebody that keeps telling us information that changes it within 3 months aggressively. So to make the assumption we know what Jerome Powell and the Fed is going to do 3 months from now, I don't think makes a lot of sense. What makes a lot of sense to me is financial conditions are tightening as rates have gone up. The financial markets are pulling back. That sets the stage for, again, that lower rate Fed rate cut environment later in the year. And that kickstarts it once we get through this indigestion.
How much is this Federal Reserve leading and not following more than people realize? How much did they actually cause the stickiness of the inflation by the initial pivot late last year? And right now, the repivoting back to a tighter kind of monetary policy is what's causing the indigestion that might allow them to cut rates. Is that what we're looking at? That essentially they're going on a dovish tact at the end of last year was a policy error that allowed inflation to run hotter than a lot of people thought?
Lisa, they've got it right once. By tightening like they have without creating a recession. That was 1995. So the immaculate 1995 scenario is what everyone is hoping for. But the Fed is managing monetary policy by talking versus acting. They haven't changed anything. So if you're raising money at the federal government level by short-term T-bills, you're still doing it at over 5%. Money markets are still over 5%. So until they actually change and I'll leave you with this main thought. What could possibly lead to a broader market recovery versus the historically concentrated market we've had? Two things. Number one, you have to have the Fed actually cut rates. Until then, we've seen it very clearly this year in the behavior. Now with the Russell 2000 down on the year, you need rate cuts to broaden out the market. That's the indigestion. Number two, you need a broader distribution of earnings contribution. You can't have 7 stocks contributing all of the growth on a year-over-year basis. The good news is both of those are set up for as we exit the year. In the fourth quarter, it's going to be a much more even earnings contribution. And with the way that the Fed is talking about rates now, creating a tighter financial conditions, that's going to end up leading to even lower rates as we end the year.
Tony, we touched on it at the top of the show, but we'd love to get your thoughts on where you see oil prices going in the sense that how difficult is it going to be for the ECB and the Fed to combat?
And Marie, it's a really hard call because it's a commodity call that's under momentum. So now just as everybody's talking about energy and higher oil prices, you've seen now some estimates come out, it could go to over $100 a barrel. Now it's starting to drop. Remember, ultimately energy goes to supply and demand. The currency situation that we have is because there's no growth. The problem globally is you need growth. You need demand to pick up. So I am not a commodity analyst, and I don't want to pretend to be. What I do suggest is when everybody starts to get excited about and trade the momentum of a commodity, it typically tends to reverse, especially if the supply and demand dynamics kind of reinforce that, which I think they do. Higher rates are not great for economic activity, and that's showing up in currencies, and it should start to show up in some of the commodities.
Hey, Tony, wonderful to catch up with you, sir, to get your thoughts. Tony Dwyer there of Canaccord Genuity, always humble about what he doesn't know, and there's a lot we don't know right now. If the year ahead, if basically a key part of the year ahead is what happens to the price of crude, what do we always say about a price of crude? If you want to make a fool of someone, ask them for their forecast on a price of crude by the end of the year. It's tremendously difficult to do, and we're sitting here saying that's going to be a big feature of a whole set of decisions that are going to be made this year, including from the ECB and how many rate cuts they deliver in 2024.
Especially when so much is really determined by something else that you cannot predict, which is a crisis in the Middle East. Since when have you been able to predict how this is going to transpire? And yet, if there is some sort of protracted conflict, which is very much on the table for a lot of strategists, you could get the closure of the Straits of Hormuz, which leads to oil supplies getting curtailed, and that could lead to a real pop in oil prices.
And I like what you said, Lisa, earlier about how this is a pause, because it's the geopolitical risk premium that we saw everyone buying into when things were heightened, now starting to come off the table. But what happens when that's back on the table? And also overnight, you have the United States deciding with Venezuela they're not going to extend some of these contracts. It's not affecting physical supply right now, but you can see certain corners of the world where supply might be hit. and how difficult that's going to be if you have a crisis on top of it.
Crude right now down 1%, 81.79. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Let's catch up with Danny Berger. Hey, Danny.
Hey, John. Taiwan semiconductor manufacturing had better than expected revenue outlook and is sticking with its plans to spend as much as $32 billion this year. So that upbeat outlook, it also follows the chip maker's first profit increase in a year. Strong AI demand, no surprise there, boosting TSMC's growth. It also comes at a time for a chip correction for many stocks, so maybe this is the thing needed to turn around sentiment. UBS planning another round of layoffs. The cuts this time coming as the bank is looking to trim headcount as part of its integration with Credit Suisse, an ongoing story. It's more than 100 positions across banking, markets, and wealth management will be cut, according to people familiar. Doha's Hamad International has been named world's best airport. It edged out 12-time winner Singapore's airport in the Skytrack World Airport Awards. But, I mean, do they even have a waterfall? Asia had a strong showing in the top 5. Seoul and Tokyo's twin facilities took the 4th and 5th spots. Hong Kong's airport saw a significant boost, moving up 22 places to 11th place. That's your brief, John.
Danny, thank you. Still waiting for JFK to break it into the top 5. When's that going to happen?
All I can say is LaGuardia is actually beautiful, and I never thought that I would say that.
Beautiful is not a word I would use for that airport, but
okay,
it's better.
come on. There's some
Do
beautiful.
not hold your breath, John.
I mean, have you seen the waterfall that goes?
Sure.
No, that is not
Beautiful
a
is not a word I would go to.
Well, you should. That is not a real waterfall if you ask anyone in the Doha airport.
Is that what it takes to satisfy you at an airport?
Yes.
Just water falling
Correct.
down? Okay.
Except that like
Go
goes
Dubai.
to music. Okay, thanks.
Up next on a program, Speaker Johnson's Moment of Truth.
I have a job to do here, and I'm going to do the job. And regardless of personal consequences, that's what we're supposed to do. If Marjorie brings the motion, she brings the motion, and we'll let the chips fall where they may.
That's coming up next, live from Washington, D.C. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
4 days of losses on the S&P 500, the longest stretch since early January. I've said a few times over the last few months, we've been absolutely spoiled in this equity market, and I think that's an example of that. 4 days, Bramo, longest losing streak in a few months. That's how good this market's been.
So it raises this question, is it a buyable dip? We've had basically a 4.4% drawdown in the S&P from some of the recent highs, which is the biggest that we've seen since the October beginning of this rally. And the question is, okay, does this open up the path for all the people who said they were going to buy the dip? Is this a dip?
5 minutes ago, 5,500 didn't sound like a punchy price target. All of a sudden, it's back in play. Feels like serious upside.
Yeah, well, especially, yes, which is kind of funny and shows how quickly Wall Street was moving. But it also shows the uncertainty right now with respect to, is this the new normal with respect to the yield space, and what's going to happen next? That's what we say, it's a pause. We're kind of in this uncertain tipping point in terms of rhetoric and narratives.
Equities firmer by 0.1%, yields just a little bit lower. Under surveillance this morning, Speaker Johnson's moment of truth.
It is different than the Senate's bill. For the Ukraine piece, for example, we've introduced the loan concept. So any funding that goes to support the government of Ukraine is converted to a loan. We have a lot of new changes in here. We have accountability and a strategy shift as well. I have a job to do here, and I'm going to do the job. And regardless of personal consequences, that's what we're supposed to do. If Marjorie brings the motion, she brings the motion, and we'll let the chips fall where they may.
Here's the latest this morning. House Speaker Mike Johnson pushing ahead with a $95 billion foreign aid package for Israel and Ukraine. Johnson planning a series of votes on Saturday, despite at least 2 House Republicans threatening to oust him. Ed Mills of Raymond James writing this. The wild card is if House Republicans stick together and add on border provisions that are poisoned for Democrats in both the House and Senate. Speaker Johnson has been dealt a tough hand, but he has a path. Ed Mills joins us now. Ed, good morning to you.
Morning, John.
How narrow is that path?
I think it's actually okay. Speaker Johnson yesterday came out and for the first time really called for Ukraine aid. What is going to be on the floor this weekend is essentially what passed the Senate a couple months ago, but they're going to have individual votes. So we're going to vote separately on Israel, Ukraine, Taiwan. There's going to be a 4th bill that is on TikTok and a bunch of other Russia-related provisions. And then there's going to be a border security bill. I think the border security bill falls off, but those other 4 bills come together, move over to the Senate, and when the Senate comes back on May 1st, this gets sent to the president. It gets signed into law early May.
We saw UK Foreign Secretary David Cameron go to Mar-a-Lago. Now we see former President Donald Trump sitting down with Andrzej Duda of Poland. How much is the international community having to put pressure on the former president for him then to say yes or no to some of these hard right members of whether or not they can vote for some of these packages?
So, Emery, I think those meetings are just good due diligence, that there is a very high probability that Donald Trump could be president again next year. And so if you are a foreign leader here in the United States and you have an opportunity to meet with the future president, you have that. I think as it relates to these defense bills, his influence has been shown in the fact that the House has not passed these bills yet. But now that we have had the attacks directly from Iran against Israel, the pressure really is there for Congress to act. And Congress is going to essentially pass what the Senate did months ago, send it to Biden's desk with a couple of additional provisions.
Given these are all separated out and we have different individual bills, when they go to the Senate, they potentially could be one package. And in that sense, I'd love to ask you about TikTok. Does that mean TikTok has a chance to actually make it through?
TikTok's the time is numbered here because this bill, Senator Cantwell, who is the chair in the Senate on the Senate Commerce Committee, has come out and endorsed the provision that has been added to the House bill. This House bill is going to pass. It overwhelmingly passed previously. And so those 4 bills are going to be combined. Those 4 bills are going to pass the Senate. And sometime next year, TikTok is going to either have to divest its Chinese ownership or shut down here in the United States. My bet is probably shut down because I am not quite sure that the Chinese Communist Party is going to allow that divestment to take place and that algorithm coming over to the United States, and for us to truly understand what TikTok is collecting and how TikTok is influencing a lot of the kind of conversation here in the United States. The reason we're passing it is real national security concerns. China's not going to want us to have that full information of what exactly they are doing with TikTok and other apps.
They've actually come out and said they're not going to allow them to divest. So that's part of the reason why I think a lot of people would agree with you. Can you help me understand why exactly this got attached to aid to Ukraine and Israel?
Well, it's a good question, Lisa, because the reason it's getting attached is because it's the only thing that's moving. And Republicans in the House want to get some victories. Republicans are concerned that the Senate was going to slow walk the TikTok ban. This is the way of getting something being a political off-ramp for them to say, it wasn't just the Senate passed bill, we got a couple of our priorities in there. And what we've seen from Speaker Johnson is that when he puts something on the floor that is against China, it is the only truly bipartisan thing in D.C. The TikTok bill passed overwhelmingly. A data broker bill that really is going to limit what type of data Chinese companies are able to purchase in the United States, passed 414 to 0 in the House. That's also in this bill. The House Ways and Means Committee is passing a bill that would impact Temu, Shein, other online retailers, trying to remove that de minimis exception. Those are the questions I'm getting the most this week at Raymond James, is all of this anti-China bills that are live balls that are going to find their way to the president's desk sooner rather than later.
So basically, this is a way to make everyone feel a little bit better as they pass aid to Israel and Ukraine and sort of get them on the same page, which raises this question: how much are the Democrats going to back Johnson if some of the Republicans fade away?
So if Marjorie Taylor Greene is the person who brings up the motion to vacate, there is absolutely going to be enough Democrats on board to make sure that Johnson remains Speaker. If the reason why Republicans are going to try to remove Speaker Johnson is because he brought up essentially the Senate-passed defense bill, they're going to back them. The reason why Democrats didn't back Kevin McCarthy was his role in rehabilitating President Trump after January 6th, his role of making January 6th partisan. That's what you hear from members. Johnson didn't have a similar kind of bad kind of feeling among Democrats. Democrats are going to want to have some level of keeping the House in order.
Ed, can we talk about why we're here? We're in town for the IMF World Bank spring meetings, and I think we're all trying to figure out how long is the line outside of the Treasury Complaints Department? And is it filled with people from Japan, Malaysia, South Korea? Are they complaining about FX and what's happening with a stronger dollar? Are the Europeans still complaining about industrial policy in America? How many complaints is this administration receiving?
The complaints might be long, but I don't think there's going to be a lot that is done with this. Probably about 6 months ago, I was on with you all, and we're talking about the concern has been that the strong dollar or kind of higher yields in the United States was going to kind of cause a lot of problems in the U.S. What we were talking about is how that was really kind of a fusion between the Treasury Department and the Federal Reserve, and the fact that was supporting our reindustrialization. And, you know, a lot of folks might want to rate cut, but there's also a lot of folks who love getting the yield out of their money market account.
Yeah.
Yes, we talk about $1 trillion debt service burden, but that's $1 trillion hidden fiscal stimulus to the economy, especially among wealthy individuals. And guess what? Monday this week, they sent 40% of that back to Treasury, and I don't think they sent that with a thank you note. So they're also lining up in front of Treasury asking for kind of some of their money back as well.
Very well framed. Ed Mills of Raymond James. Ed, thank you. Big issue, isn't it? As always, it's our currency, it's your problem. Seems to be the message.
And frankly, right now, we understand, we acknowledge. What else are they going to do? Nothing. And that's basically what we're hearing.
Coming up on the program, the conversation continues. We'll catch up with Leland Miller of the China Beige Book, live from Washington, D.C. This is Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Equities on the S&P 500 pushing just a little bit higher, firmer by 0.2%. Your equity board shaping up as follows. Well, the S&P 500 doing okay. The Nasdaq up by 1/3%. The Russell, which has been absolutely hammered, and was down again yesterday, is positive by 0.1%. It is a 4-day losing streak on the S&P 500, the longest stretch since the first week of 2024. If you switch out the board and get to the bond market, yesterday was a little bit different, Bramo. Yields pulling back, not pushing higher. Yields down again by a single basis point, 4.57 on a 10-year. The 2-year backing away from 5%. Bramo, 4.92.20.
People are starting to buy. And on the margins, you start hearing this under the surface, whether it's pensions that have bought a lot of stocks now are going to sell them and move into bonds, or whether it's just this idea, we're not going to get this that much higher. You're starting to feel it. You saw that in the 20-year auction. To what degree, though? When does that get tested? And today, Vanguard was saying if you get to 475 on the 10-year, that's going to trigger a real problem that'll get you to 5% pretty quick.
This FX market is crying for a little bit of dollar weakness, and that's what it's got right now. So let's switch up the board and get to foreign exchange. But we'll look at some different currency pairs. We started the program this morning as we kick off our coverage of the IMF World Bank spring meetings, talking about the pushback we're receiving from places like Japan and South Korea, threatening to intervene in the FX market. Malaysia actually has done. They've had to step in. It's been weakness, Bramo, across the board for some of these currencies, grappling with the strength of the US dollar. And what are you fighting? You're fighting fundamentals. And that's the problem. How difficult is it to intervene and stop that train?
Well, you can see it right there in the number, 154.47. That's what verbal intervention got you, a whole lot of nothing. And basically, that's what you're looking at, because what can you do? If you're the Bank of Japan, and each of these stories are different, right? But if you're the Bank of Japan, the only thing you really can do is to hike rates aggressively, which you're not going to do. And even that isn't clearly going to get you what you're looking for. So at a certain point, they can jawbone all they want. The market's calling their hand because they're looking at fundamentals.
I keep going back to that meeting in the last 24 hours between the Treasury Secretary and representatives from Japan, from South Korea. This is clearly an issue in Washington, D.C. this week.
Oh, absolutely. You said it best, Jonathan, when you said how many people are lining up outside the Treasury's door for meetings because of the issues they have, whether or not it's Asian countries and they're dealing with the stronger dollar and then the weakening of their own currency, but also in Europe. When it comes to things like the Inflation Reduction Act, there's still a little bit of tension. Also, the fact the United States wants to see harsher sanctions on Iran, that means getting the Europeans involved.
Yeah.
It's a difficult position because they have to give a little sometimes to get a little when they want this multilateral approach when it comes to places like Russia, Iran, and China.
It's an odd occasion, Lisa, because the United States is spending a lot of time complaining about policy in China. And I'm not saying they're wrong for doing so, but the rest of the world appears to be complaining about policy in the United States. And this week, we just hear those complaints on repeat.
Especially given the fact that the U.S. continues to grow, and a lot of people are saying, well, that's because you guys borrowed so much to fuel your fiscal spending, which allowed you to grow so much. At this point, that is going to be the key question. How much is there some sort of coalition of like-minded peers, allies, at a time when there's so much disagreement within said allies? And by the way, that Iran issue, it's actually tied to China. Did you see the story this morning that Iran has actually been accelerating its output of oil and selling it? Who's it selling it to?
The teapots in China, 80%.
Correct.
Last month, 3.5 million barrels a day. This is what was so frustrating when you speak to the administration when they say, well, we have sanctions on Iran. Having sanctions on Iran is one thing. That's a piece of paper. Enforcing them is a completely different story.
It's a conversation they won't entertain, though, right? We tried to have that conversation earlier this week. Didn't go well.
It didn't. And they continuously pushed, and they say that Iran is isolated. It's very hard to see Iran being isolated when they're exporting the oil to China, weapons to Russia, as well as the foreign minister today in New York. That's not isolation.
Brent crude right now down by 1%, $86 and about 30 cents. Under surveillance this morning, our top stories. Cleveland Fed President Loretta Mester and Governor Michelle Bowman urging patience in a fight against inflation. Bowman going a step further, saying progress may have stalled and only time will tell if rates are sufficiently restrictive. What's interesting is the conversation that market participants are having, the only person on the FOMC that's having it is Governor Mickey Bowman, because very few others are having a conversation she's having about whether we are truly sufficiently restrictive.
They don't want to go there because basically that introduces the question of rate hikes, and they don't want to put that on the table. And that's very clear. They want to take rate hikes off the table, which is the reason why I'm interested in speaking with Jonathan Pingle over at UBS, who starts talking about the potential for a 6.25% Fed funds rate next year if you don't get some sort of deceleration of inflation.
8:30 Eastern time for that one, 2 hours away. Don't miss that conversation. Let's turn to our next story. House Speaker Mike Johnson putting his job on the line, looking to pass aid for Israel, Ukraine and Taiwan. Johnson is planning a series of votes this weekend for the $95 billion aid package. President Biden endorsing the legislation and urging Congress to act quickly. The question we've got for him is the question we had for Speaker McCarthy. Can he pass this and keep his job?
Well, Ed Mills thinks he can. He thinks he can pass all of these packages and keep his job because, of course, like we've seen everything else that comes out of the House of Representatives, the Republicans have such a slim majority, Democrats have to be there for the votes. And Ed thinks because potentially there's not the relationship that former Speaker McCarthy had with former President Donald Trump, it's not as intense the way that the current Speaker Mike Johnson has with the former President Donald Trump, that some Democrats may get in line and vote for him. But then after these bills, it's off to the races, and it becomes all about November and the election.
Well, let's talk about the election and the complaints we're hearing from President Biden taking aim at China while surrounded by U.S. steel workers. At an event in Pittsburgh, Biden calling the country xenophobic while pointing to China's economic woes. Leland Miller of China Beige Book saying this: the narrative of China's collapsing manufacturing was always a false read of true conditions on the ground. Leland joins us now for more. Leland, we could talk about the economy. We've got to talk about the politics as well. Are these complaints from the United States, from the White House, justified when they're talking about the prospect of overcapacity and dumping in global trade?
Well, there's a fascinating academic debate going on whether we're at overcapacity or whether we're about to get to overcapacity. But it's compelling enough that Europe is now paying attention and the United States is now preparing its own response. So I think the key thing here is not whether you're seeing the flood of Chinese cars. Obviously, you're not seeing Chinese cars on U.S. roads. This is something about 2025. It's about 2026. The Chinese cars have been in a protective cocoon for about 10 years. Being massive subsidies, massive protectionism inside the home market. And it was very competitive, and now the domestic market is getting closer and closer to being saturated. And they are liberalizing the laws and the rules and the regulations, and these things and these cars are ready to go out. But the domestic market's saturated. There's too many companies. They're going to have to go somewhere. So I think everybody's just looking not at today, maybe not next month, but next year, and saying we have got to prepare a response because this could be problematic.
It's kind of strange to me, Leland, that we're having conversations we've been having for a long, long time. These conversations about dumping are decades old. The goods have changed. We're talking about EVs. We used to talk about something different before. I remember, though, this wasn't going to be an issue. We were having this conversation about the future. China would move away from this manufacturing base. It would be less about exports, more about consumption domestically. What does it tell you about the trajectory of the Chinese economy and where they are, that we're still having this conversation in America?
Well, it hammers home the idea that you need to always see what they're doing, not what they're saying. So, we heard for a decade plus that there was a shift going on from investment to consumption. Now, they downshifted investment. Consumption hasn't gone everywhere. And you see what happened very recently at the National People's Congress last month. They took Xi Jinping's new mantra, which is, about new productive forces, and they announced that is going to be the government's economic program going forward. They're going to have a whole of government program that's going to help these companies in new, advanced, particularly green sectors globalized. So the entire Chinese government is going to be about getting their technology around the world. This is production, production, production. This is why you see exports so high and imports so low. It's a problem because not only does China have trade surpluses with just about everybody, these trade surpluses are going to get bigger and bigger and bigger if they're dumping around the world.
Leila, we're on the edge of these China tariff EVs almost becoming like infrastructure week. Everyone's talking about it for months, going to China and talking about it in their face. Is there a disagreement in the White House? Because why is it taking so long?
This White House disagrees with itself on just about everything. And when it comes to actually putting some sort of policy in place, I think that if you had some of the trade hawks administration, they have been wanting to do this for not just weeks or months, but for years now. And nobody in the White House is willing to give the green light to let them do this. Now it's getting political. We're in campaign season. We're talking not about solar, which is sort of existential for people. We're talking about cars. And cars are political, and this is campaign season. So I think some of the resistance you've seen politically, especially within the White House, to moving forward on some of these trade actions, it's starting to dissipate.
Is a more important relationship that the White House needs to worry about is less so Washington, Beijing, but Mexico and Beijing? Because if the United States ups these tariffs, isn't there going to be a tremendous amount of dumping into Mexico and then potentially leaking into the U.S.?
Well, that's the big worry. So the worry is that, you have this 2% tariff for USMCA across the Mexico border. A lot of Chinese companies are already starting to plan and build plants in Mexico so they can just produce them in Mexico and then drive them across the border. And you miss the whole China trade war part of this unless you step in and you deal with transshipment and you deal with the build out of factories in Mexico. That absolutely will be part of the policy response. And that's a lot more legitimate than thinking that, suddenly waves of Chinese cars are going to appear at U.S. shores.
There's been speculation that China is deliberately allowing its currency to weaken in order to expedite some of the exports of some of their goods. Do you buy that?
I don't think so. I think they're very nervous about their currency overall, and China's sweet spot is stability on the currency, and that makes everything else go better. So I think what they want is, they would want a stronger economy if they could have it. You have a supercharged U.S. dollar over the course of many years, and the yuan, though most people don't realize it, is soft pegged to the dollar. So they have had to keep up with dollar strength for a number of years, and now they're just trying to let off pressure wherever they can without sending a political signal that's going to get them in trouble.
Is it a fiction here at the IMF meetings that China is actually an equally an engaged member, considering the fact that we're hearing a lot of pretty poisonous rhetoric around China from pretty much every member of the IMF?
Well, I think it's become more acceptable to be more critical about China. I think that the issues here have been building the production, the exports, the fact that everyone calls China a global growth driver, but you're not a global growth driver if you're juicing your exports and you're minimizing your imports. What you're doing is actually hoovering up demand from the rest of the world. So I think that has really gotten under the skin of a lot of people, and that sort of negativity on China is something that's not American, it's not European. I think everybody is getting mad at China for that.
The last time we were at the spring meetings for the IMF, we talked extensively about whether the IMF would come up with something that would counter the Belt and Road type of initiatives, that China's kind of going it alone to help different countries and exert influence. Do you see that happening more actively at a time where people are being more vocal in their criticism?
No. I mean, I'm never of the belief that an international bureaucracy is going to get itself together and do anything productive. So no, I don't think we're going to be moving in that direction. I think people are worried about Belt and Road, but at the same time, the Chinese themselves look at Belt and Road and they can't afford what they've planned out. So they're being more specific about what they're actually putting effort and money into and what they're pulling back. So I think there's a lot of issues in terms of China policy. Belt and Road is not front and center in terms of what I think we need to be worrying about right now.
The complaints have just come too late, Lisa, particularly from some of these institutions in Washington. They've come far too late. The hope, and we've talked about this a few times on this program, the hope was always that China would become more like the West and that these institutions would help facilitate that. The fact of the matter is China has not become more like the West. And in many ways, just in many ways, China has been a leech on the global international trade system for a long, long time. And we'd sit here and have conversations with officials from all kinds of places, and they'd be hopeful that that was going to change, that China would move away from this export-led growth, they'd go towards consumption, they'd become more like us, they'd open up, that would continue. That hasn't happened. I think the reason you're getting the complaints now, and we can have these conversations with officials through the week, I think the reason we're having these complaints now is because they lost, and they can't fix it. It's too late. Because what you're seeing in the United States is them slide back into industrial policy. What the Europeans are realizing is they've got to do the same thing. So all of these hopes and dreams of having this globalization continue and China being part of that, it's over. It's over. And I think what these institutions this week have got to figure out is how they find relevance in that world, how they shape some of these decisions that are being made, because it's becoming increasingly difficult. So I'll just put a bow on it. They lost. It's done. It's over. It's not going to happen. Industrial policy in the United States, this is the future. We see a massive agreement in Washington. You know, we can disagree over a lot of things in D.C. I can have my own view on free markets. You can have yours. In Washington, where there is agreement, it's on things like this: industrial policy and tariffs and going against China. And the hopes and dreams of them becoming more like us, forget them. Dead and buried. Gone.
There is a way, though, to do it with more cohesion. And I would like to hear, you know, if there's this idea that maybe the U.S. wasn't necessarily ahead and very far behind when it came to industrial policy. But guess what? Industrial policy is getting revolutionized by new technology. What if the U.S. has an upper hand in being able to recreate and reconstruct an industrial policy with AI, with different technologies, without disrupting millions of people who are employed by that sector? There are ways to play this if you are cohesive about it.
Agreed. Leland, this was awesome. It's just fantastic to get your thoughts, as always. Leland Miller there of the China Beige Book. Let's give you an update on some stories elsewhere. And let's get you the Bloomberg Brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Donald Trump's campaign wants other Republicans to pay if they use a former president's name, image, or likeness in any fundraising. According to a campaign memo obtained by Bloomberg News, all candidates and committees who use Trump in their fundraising appeals must give a minimum of 5% of the money they earn to Trump's political operation. Shares of Micron higher pre-market, up by 1.6%. It's the largest U.S. maker of computer memory chips and is poised to get $6.1 billion in grants from the Commerce Department. It would help them pay for domestic projects, all of it part of an effort to get semiconductor production back to American soil. The award is expected to be announced next week, according to people familiar. Google has fired 28 employees for protests against Project Nimbus. It's a $1.2 billion joint contract with Amazon. It provides the Israeli government with AI and cloud services. The protests, led by the, quote, No Tech for Apartheid organization, took place in a number of Google offices on Tuesday. Protesters in New York and California staged a nearly 10-hour sit-in, with others documenting the action, including through a Twitch live stream. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the path to 2%.
What we've seen over the first few months of 2024 anyway, is that progress on inflation has slowed. And I expect maybe it's even stalled at this point.
That conversation coming up next from the nation's capital. This is Bloomberg.
I was around so many powerful people in my entire life, from the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from Washington, welcome to the program in the nation's capital for the IMF World Bank spring meetings. Equity futures right now just about positive, trying to bounce here by a third of 1%. Yields are a little bit lower by a single basis point. The 10-year 457.11. Under surveillance this morning, the path to 2%.
What we've seen over the first few months of 2024 anyway, is that progress on inflation has slowed. And I expect maybe it's even stalled at this point. We've seen a little bit of a stalling in progress in lowering inflation. So I think it is restrictive. I think time will tell whether it's sufficiently restrictive or binding.
Here's the latest this morning. Cleveland Fed President Loretta Mester saying the central bank shouldn't rush to cut rates, adding, quote, "I still am expecting inflation to come down, but I do think that we need to be watching and gathering more information before we take action." More Fed speak on deck today with Fed Governor Michelle Bowman, New York Fed President John Williams, and Atlanta Fed President Raphael Bostic. With us around the table, I'm really pleased to say, here in Washington, Tiffany Wilding of PIMCO. Tiffany, good morning to you. Let's talk about Mickey Bowman, because I think Governor Bowman on the FOMC seems to be the only one exploring whether we are truly sufficiently restrictive or not. Why is she so lonely?
You know, it's been so funny that you haven't had more people talking about this. I mean, you can literally just look at the growth numbers and know, we're kind of running 3% on a final domestic demand, so core growth. It looks like we're going to run that in the first quarter, maybe even in the second quarter. We haven't had 4 consecutive quarters of that kind of final domestic demand growth since 2000s. We have a lot of growth in the United States. I would even venture to say the U.S. is quite boomy right now. That does not seem like an economy that has restrictive monetary policy. And of course, in that kind of environment, you would expect inflation to reaccelerate. So I'm with you. I'm surprised she's the only one talking about it.
So we've heard some calls this week, some big changes. The likes of Bank of America, Deutsche Bank now say December. There are some banks who are saying no cuts whatsoever this year, including the likes of SocGen, and Apollo's another name, Torsten Slok, who's basically saying no cuts in 24.
Yeah.
Where are you in the team now on that issue?
Yeah, so we agree. We think that ultimately they are not going to be cutting in the middle of the year, as they had previously been clearly telling us they were going to do. But I think what they will do at that June meeting, which will be important, is they will show us their new SEP, and that is where we will get, I think, clearer guidance on when exactly they expect to cut. I think there was like a quick rule of thumb that they were using in January, which was that we needed to see 2 more consecutive quarters of 2-point-something inflation. Inflation was 3.4, or will likely to be 3.4 in the first quarter, and our own forecasts are that it's going to be 3 in the second quarter. So if they still need to see 2 quarters of 2-point-something, then that kind of suggests December might be the first time that they're looking to potentially cut. I think it all depends. They have wiggle room. They can, monetary policy is more of an art than a science in some sense. But I think there's definitely a clear message that's coming from them, at least, that they're not going to be cutting mid-year.
If Mickey Bowman has lunch with Neil Kashkari, maybe even has lunch with Fed Chair Powell and starts to talk about sufficiently restrictive, that starts to put the idea of a rate hike back on the table. Because if you're not sufficiently restrictive and you're looking at inflation that's running hot, well, as Jonathan Pingle over at UBS says, that raises a specter next year of additional rate hikes that he sees potentially even going to 6.5% for the Fed funds rate if we don't get an inflation rate below 2.5%. Do you agree?
Yeah, so we think that, again, that 3 is a big number, that 3% threshold, so 2-point-something. So if they're seeing inflation that's reaccelerating to above 3 and looking like it's going to hang there, I certainly think that that'll be a problem for them. In terms of how they message it, I think it has to be a message of policy is not as restrictive as we thought, therefore the underlying neutral rate in the economy is maybe a little bit higher than we thought. And that's a longer-term issue. And by the way, they have a longer-term review of their monetary policy strategy coming up in 2025. So, going through the academic exercise of reviewing all these models, and thinking about that, it's kind of an opportune time, if the economy is behaving like that, if inflation is still above 3, to really start to talk about maybe neutral interest rates are higher.
It becomes incredibly difficult as an investor to understand how to play this, especially when the relationship between stocks and bonds has gotten so confusing over the past few years. You believe that eventually we're going to see a sort of going back to the old normal of bonds and stocks moving inversely. How long will it take to get there, given that we don't really even understand what sufficiently restrictive means? And if you get higher yields, that might not be positive, or that might be really negative for stocks. We just don't know.
Yeah, I mean, so we think that we're getting closer to that kind of environment now. And the reason is just because we're not at 8% inflation anymore, right? So, I mean, at the end of the day, we're talking about, you know, are we going to get 2 point something? Maybe we get a little bit above 3. But I don't think anybody is really estimating, you know, with absent some supply shock, that inflation really materially reaccelerates. So in that kind of environment, the Fed can still be as reactive to unemployment rate increases and you know, additional evidence of potential economic downturn as they are to inflation. And it's really that balance of risks being more balanced that gets you that negative correlation between stocks and bonds. So we still think bonds are going to be a good hedge for equities here.
Do you think the Fed needs to start thinking about just targeting 2 to 3%? Instead of talking about going right back to a laser precision 2?
Yeah, I mean, I don't think they will ever admit to that. I mean, certainly that will be more of a discussion in 2025, I think, during their monetary policy review. Powell, it seems like from his conversations, has sort of taken that off the table. They are really worried about a credibility issue with raising the inflation target when you can't get it back to 2, which is understandable. You know, but I think if you take a step back, there's just not a lot of academic discussion around what are the cost benefits of 2 versus 0 versus 3. And like I said, you know, there's some wiggle room here, I think. So, I mean, I think what could play out is that they're willing to tolerate a little bit of above target inflation for a while. I still think that threshold is 3. They'll always forecast it getting to 2 in the future, but we'll just realize, you know, some higher inflation than target. And by the way, you know, when we look at the TIPS market, you know, I know a break given inflation rates have increased a little bit, but, you know, that does not seem to be priced into the psyche there.
Then when you look at some of the language coming out of the Fed, and we heard from Powell this week, he's almost implying that the latest hot prints we saw in inflation are not just bombs, and you're almost saying this is the new trend.
Yeah.
Is that correct?
Yeah. I mean, you know, I think in our minds, it's always been, you will probably need to see more easing in the labor markets, some higher unemployment. The Fed is basically saying we can achieve all of this, you know, without higher unemployment. And we've sort of been skeptical of that. And I think what you're seeing play out in the economy right now is that you're getting a hot economy, and that is actually putting upward pressure on inflation. You're seeing it in the core services, ex shelter categories, the Fed's, you know, super core measure that they like. But you're also seeing it in shelter. You know, shelter has really stalled. You know, part of that is just because we have, you know, the supply of houses. We've underbuilt for the last 10 years. And the fact that you've had a price, you know, a level adjustment that's happened in the housing market, in the rental market, that just the OER has not caught up with, you know, you're just not going to see a fast deceleration there. You know, so all of that sort of suggests to us that, yeah, we are kind of in this prolonged period of higher than target.
Tiffany, this was great. It's great to see you on tour as well, here in Washington.
Thank you.
Thanks for being with us. Tiffany Wilding there of PIMCO. Echoing some of the things we heard from Stephen Stanley of Santander, the Fed became enamored with the combination of really strong growth and benign inflation. And Lisa, they were looking for that to continue through 24, and there's clearly a challenge to that based on the data we've had so far.
And one of the more compelling arguments is that their embrace of that narrative is part of what has allowed inflation to remain stickier because of the verbal intervention and easing.
Coming up in the second hour of Bloomberg Surveillance, we'll catch up with Alethea Dorawala of Rock Creek, Bloomberg's Michael Shepard, former IMF First Deputy Managing Director, John Lipsky, and Tim Adams of the IIF. From Washington, this is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
The restrictive policy that the Fed wanted in place to try and bring inflation down, now we're starting to see the swing back the other way.
I don't think we're out of the, out of the woods here with inflation pressure.
It's not just that the rate cuts are less than later, but it's also, is inflation higher?
When you look at what's driving inflation, or at least keeping it sticky, a lot of it's supply-side factors.
The real risk is the second half of this year, inflation actually starts to move back up again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So yesterday you got everything you wanted. You want lower crude prices, that's what you got. Oil down. You wanted a weaker dollar, you got a bit of that as well. Yields lower, you got that too. Couldn't buy you a day of gains in the equity market. 4 days of losses on the S&P 500, longest losing streak going back to the start of 2024. Live from Washington, D.C. this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on tour, covering the IMF World Bank spring meetings with Anne-Marie Hordern and Lisa Abramowitz. I'm Jonathan Ferro. We've got to talk about the complaints from one side to the other. The complaints from the United States on policy coming out of China, and Lisa, the complaints from everyone else about policy coming out of the United States. That kind of frames this meeting in Washington, D.C.
And frankly, the specter of Donald Trump coming back to the office, how much is that also included in some of the geopolitical risks that people are talking about? It's a fraught moment when you're talking about a trilateral or multilateral world. What are the lateral aspects of it? Is it going to be China, Iran, and Russia, and the U.S., and who, right? Is it going to be the U.S., Japan, South Korea, as well as Western nations when they are having issues with the U.S. industrial policy and the strength of the dollar?
Well, at the moment, America is bathing in U.S. exceptionalism, and the strength of the dollar is a consequence of that. The strength of the dollar is causing problems. And I keep going back to this meeting between Secretary Yellen and officials from Japan, officials from South Korea. To Lisa's point, the dollar at the epicenter of some of these concerns.
Right, and you saw all these three finance ministers get together, and basically they all agreed that the currencies are too weak. And it felt like it was the U.S.'s response and way to say, we understand if you have to intervene. But to Lisa's point earlier, what does that mean? Can they actually go in and intervene? If they do, does it even matter? Because how are they going to fight this Fed? And that's why at this IMF, you hear about this U.S. exceptionalism due to loose U.S. fiscal policy, making it harder to get back to the 2% U.S. inflation target. And what does all of that mean in terms of bond yields and higher dollar on the rest of the world.
Let's go to the quote from the G7 on foreign exchange. Read through this with me. Lisa, excessive volatility, disorderly movements in exchange rates can have adverse implications for economic and financial stability. Is there anything excessive volatility, anything disorderly about the movements we've seen so far? Isn't this all based on policy fundamentals in America versus everybody else?
Well, it's disorderly because it creates a real problem for the central banks in other countries to be able to actually adhere to what actually is best for their economy. So yes, I think a lot of people would say it's disorderly because it's crossed certain thresholds and they don't like it. You know, ultimately, it's very difficult to know as an investor what can be done if it is very logical that this is happening. You say disorderly. I'm a bit tongue-in-cheek because ultimately this is a direct derivative of the fact that we're talking about U.S. exceptionalism, tighter Fed policy on the heels of inflation, and a weaker economic growth in the rest of the world. That's textbook for what you're going to get in terms of the currency move.
And if you're concerned about U.S. fiscal policy, the IMF is talking about the fact that they don't see a short-term fix for this because, and you mentioned former President Donald Trump, he's in the mix because it's an election year. And what happens during election years? You spend more and you tax less. So that loose fiscal policy, that's going to continue.
So everything great here. Plenty of complaints abroad. The managing director of the IMF is warning about the tepid 20s, tepid growth for the next decade or so. Lisa, if we don't adjust some of these big issues of the moment.
And I don't want to say it, but are we talking Liz Truss here? Is this basically where we're going with this? Basically, you know, the talk about the fiscal overhang.
I think you're talking Liz Truss.
Well,
I'm not sure
hold on a second.
Liz Truss.
You know, I just have to say, if you take a look at some of the charts coming out of the IMF, the U.S. debt to GDP ranks up there with China and India. It is above where Brazil is at. They are talking about this as the major risk. I find it fascinating. Crises usually happen in areas that are perceived as the safest. And right now, that's what people are looking at with the Treasury market, understanding when does that happen. Of course, this is all pie in the sky for people who want to invest in Treasuries today when they're looking at the incremental moves, which is the reason why people haven't been talking about it more. But I find it fascinating, and the IMF does too.
You know, the former Prime Minister is on a book tour at the moment. If you wanted to get her on the programme,
well,
that would
Truss,
be a good conversation.
I would love to speak with Liz Truss.
I know you would.
Please, let's make that happen.
You can run that conversation.
Thank you.
Equities right now on the S&P 500 positive, 0.25%. I think it's best I sit out. In the bond market, yields lower by a single basis point, 457.72 on Treasuries. And there's the move. Lisa, we're back down in the low 80s, 81.84 on WTI.
Well, how do you price in geopolitical risk? I mean, again, this is, you know, we could talk about all the what ifs, but if they don't come to fruition, well, then it's a buy because you have, you know, however, 3 million barrels of oil, 13 million barrels of oil being produced out of the U.S. every day. So at a certain point, it's a very difficult trade to get right until you're staring in the face of what you're looking at and what can possibly transpire.
86.38 on Brent crude right now. Coming up this hour, we'll catch up with Olivia Dorawala of Rock Creek with U.S. stocks coming off 4 days of losses. Former IMF First Deputy Managing Director John Lipsky on the Fed's path forward, and IIF CEO Tim Adams on the headwinds facing financials. We begin with our top story. The S&P 500 looking to bounce back from its worst run of losses since the start of the year. Olivia Dorawala of Rock Creek saying this: U.S. equities remain attractive, but it's still too soon to say that the time has come to be all in on small caps. Olivia joins us around the table. Olivia, great to catch up with you. It's a tradition here in Washington. It's good to see you.
Thank you so much for having me.
Let's start with small caps. Everyone wanted them at the end of Q1, and then April happened, and I think we're down 7% off the highs of March, maybe even more now after the losses of yesterday. Why is this not working in the way that people hoped it would?
I mean, I think it's all coming down to the Fed, right? And if you looked at the beginning of the year, we had almost over a 60% probability that the Fed was going to cut rates in June. Now it's at 15% with a 95% probability into September. I think to your point, the markets are all over the place. They finally kind of realized that higher rates for longer is actually what they said and what will happen, that inflation remains high, maybe for good reasons, because economic growth, the prospects are strong in the U.S. And to your point about the rest of the world, maybe relatively to the rest of the world, continues to be strong, even if there are downside risks in the long term. So I do think that, investors that jumped into small caps as a category were probably too early. I do think there's an opportunity for stock pickers.
The key phrase there that you used, for good reasons. Lisa's talked about this a lot. When you see high yields, is that for good reasons, growth, or bad reasons? Inflation, maybe it's even both. And if it is for good reasons, isn't that a good reason to keep buying stocks?
I mean, I think the question is, are we in a new regime where inflation will never get to 2%? So we're all sitting here waiting for 2%, and it just never happens. Everyone wants to look to the past, but the question is, for the next 10, 15 years, is inflation at 2.5% or 3%? And the economy is perfectly fine with that and can continue to grow. And, you know, we'll have to see what other central banks are doing around the world, because they are in a very different position than the U.S. today in terms of their economic growth prospects.
You know, when John is talking about diversification, the broadening out of the rally, I think about all of those European stocks that people wanted to buy, the granolas, right? We were talking about luxury getting skinny and the tech coming out of that region. Then what you got, LVMH, people aren't buying Hennessy as much. You get the feature of ASMR and the fact that maybe people aren't buying as much of their chip technology. And that was part of what fueled the sell-off yesterday in big tech in the U.S. And frankly, it's torpedoed what we're seeing in Europe. So how do you play that?
Yeah, well, I think Europe is a perfect case of why this is a very good active management environment. If you look at unprofitable tech in the U.S., it is down 11% from when the CPI numbers came out and 27% down from the beginning of the year. That is a very different case than what we saw last year. And I think the same goes for Europe. I think the granolas might have very strong growth prospects, and you can stock pick your way through Europe. But I think economic growth prospects in Europe as a whole are probably not where you would put your marginal dollar if you're betting on growth across different regions today.
Are you worried about the U.S. deficit?
Yes, but everyone has been for the last 10 years, and everybody will be for the next 10 years.
So this is the issue. When does it become a market issue? Because we've been all worried about it.
Yes.
We've been banging the drum. I remember my grandfather coming into his house, having breakfast with him. The deficit's too big.
And
that was like
everything.
This is like 30 years ago, you know. But at what point does this actually become real?
I think it only becomes real when somebody actually puts a solution on the table, because no solution will be good. Pain will only come with any solution, and nobody wants to deal with that. That's when the markets will react.
Well, you're based in Washington. What's the catalyst? Is it going to be them saying, like Lisa, look at this is unsustainable, we need to fix this in Congress? Or is it going to the market forces them to?
I think the market will force them to at some point, but I don't think necessarily that it's in the near term.
Are you so concerned about the U.S. deficit that you like gold?
No, gold is a diversifier in our portfolios. We run diversified portfolios, public markets, private markets. There are opportunities everywhere, but we need to be also mindful of downside risk. As much as there are pockets of opportunity in the U.S., in private equity, I mean, that's a whole nother area of really good return investment opportunities. We look at gold as a diversifier, and it's worked up until now.
What do you think it is about this regime that's leading gold to multiple all-time highs over the last few months? What is it about this particular regime?
About this particular, you know, I do think that it's a realization of investors that we are in a higher interest rate for longer, that inflation is here to stay. How do I look at my portfolio, and how do I play some sort of defensive type downside risk? How do I make my portfolio more resilient? Things like gold, and not just gold, but other safe assets are going to be a part of investors' portfolios. I think there are the investors that are looking for short-term momentum, you know, commodity-type plays, and there are those that are looking for really how to protect your portfolio.
You know, what's that line, the drugs don't work, they make things worse? Is that treasuries now? They don't work anymore. Is that what you're saying? Go to gold, because the treasuries don't work, they make things worse.
No, I think, again, you have to have both treasuries and gold.
It's also how what British doctors do. They don't want to prescribe a lot of drugs, and they don't work anymore, and you get too used to them.
It's an actual song. Do you not know that song?
I just think it was.
Why don't you sing it?
I'm not going to sing it. Alethea, thank you. I've got to leave it there, which is probably a good time to leave it there too. Alethea Dorawala of Rock Creek. Do you not know that song? Everyone knows that song. Equities right now on the S&P. Positive by 0.25%. Let's give you an update on stories elsewhere. We can do that with your Bloomberg Brief. Let's cross over to Danny
Hey,
Berger.
John. Donald Trump's advisors are pushing to keep a cap on the state and local tax deduction. Economists Stephen Moore and Arthur Laffer said that they are opposed to any increase to the $10,000 write-off cap on salt. That limit was imposed in Trump's 2017 tax law and will expire at the end of 2025. Shares of Alaska Air are higher, with the airline expecting second quarter profit to come in above analyst estimates. The carrier citing a surge in travel by tech companies and increased demand for premium tickets. The outlook also signals that the company is bouncing back following the temporary grounding of the Boeing 737 MAX 9 aircraft after the fuselage panel blew off an Alaska Air flight in January. Elon Musk says that some of the severance packages sent to former Tesla employees as part of its biggest ever workforce reduction were too low. In an email, Musk apologized and said it is being corrected immediately. Earlier this week, he announced that Tesla would slash global headcount by more than 10% as the car maker struggles with slowing demand. I spoke to Dan Ives of Wedbush this morning, who had quite some strong words to say about Tesla and Elon Musk.
This is the period for Musk. Lay it out. Don't just talk, walk the walk. Because the benefit of the doubt's not there. Yeah. And this has gone from a Cinderella story to essentially Friday the 13th.
And you can, of course, watch Bloomberg Brief every weekday at 5 a.m. That's your brief, John.
Danny, I've got to ask, has he still got a buy on the stock?
He does. He still has an outperform on the stock because he said he believes in the long-term story. It's not given up yet.
Danny Berger, thank you. Even saying those things, Bramo, still got an outperform on that stock. What's going to change it for him?
Honestly, I'm not sure, because ultimately this comes down to you got to believe. You're either in it with Elon Musk and believing that he's an innovator outside of cars or batteries or tunnels or, you know, the Boring Company, or else you don't.
He's certainly an innovator, without a doubt, but the stock hasn't performed at all this year. We're down by more than 30%. Equity futures right now on the S&P, positive by 0.2%. Up next on the program, the clock ticking on the TikTok bill.
Sometime next year, TikTok is going to either have to divest its Chinese ownership or shut down here in the United States. My bet is probably shut down.
We'll talk about that bet in just a moment. Did you find the song on Spotify?
Yeah.
You found that? I don't think you can play it.
It's the verb. The drugs don't work, but it's kind of depressing.
It's a very depressing song.
Well, so is the deficit.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
party is going to allow that divestment to take place.
Here's the latest. Congress moving forward with a bill that would force TikTok's Chinese parent company ByteDance to divest its ownership of the platform, with Speaker Mike Johnson tying the legislation to foreign aid package for Ukraine and Israel. The bill's set to clear the House on Saturday, with the Senate expected to quickly take up the measure, and President Biden promising to sign it immediately. Joining us now is Bloomberg's Michael Shepard. Mike, I think Lisa asked the question of the morning. Why on earth are we linking TikTok to aid for Israel and Ukraine? Why is this happening?
Well, strategy-wise, think about it. If you're a member of Congress and you have something that you want to see passed, if you see something else that is definitely going to get through, what do? Well, you try to attach it to that piece of legislation. And we saw this with something else. There is also another measure, an Iranian oil sanctions measure that Anne Marie, I'm sure, is aware of, that also was attached to this. And so this is a fairly common legislative strategy. The issue was that, while the House had overwhelmingly passed the measure initially about a month ago, the Senate was slow walking it. There were more objections in the chamber to the bill. They were concerned about whether it would infringe on free speech. There were others who were actually concerned about a possible lawsuit, that it could get blocked in court. The precedent of singling out one company was also something that troubled them.
Do you think they'll slow walk this?
No, it really, because it is attached to this Ukraine, Israel, Taiwan aid package, it is written in the stars that this thing will get through, barring some last-minute drastic change that will pull it away.
So it might not slow walk on Congress, but in the executive branch it could. Couldn't Biden also, though, get an extension on this so he can then campaign on TikTok through November? I mean, isn't that what it comes down to?
Well, that's a great point, Emery. And the other thing to remember is that the bill, as currently written, gives the company up to a year to divest, ByteDance, to divest the TikTok platform. And so that would take it beyond the, of course, the 2024 election timeframe and well into the new administration. And whether it's Biden or Trump, they could then make a decision about how fast to proceed and whether to actually take an action that would force the sale.
Lumping all these priorities and packages together, having these big votes, Ukraine, Taiwan, Israel, TikTok, sales of Iran oil, there's something for everyone in the House. So then you have to think, why would his own party get rid of him and have this motion to vacate? There's got to be something in there for every single member of the House of Representatives, giving the long list of provisions that they're going to be voting on.
It's a great question. This power dynamic that we're seeing in the House right now, there's one word that could best describe it, is really entropy. We're just seeing this disorder there, and it is hard for anyone, be it Mike Johnson, his most recent predecessor, Kevin McCarthy. It grew increasingly difficult for them to bring the Republican caucus into line. And one of the reasons is that a lot of these members really are less concerned about a broader agenda. The agenda that they have is often very unique to them. Somebody like Matt Gaetz, somebody like Marjorie Taylor Greene. And so what they're looking for is, it's easier for them to go after Mike Johnson than it is to try to rally the troops to hold together.
I'm going to be optimistic here.
Wow.
I just want to point that out.
Chef's in shock.
Well, I think you're in shock, but I'm going to be optimistic and say it feels like maybe people are getting sick of the dysfunction, and people on both sides of the aisle want to make it stop. And I got that sense from the fact that a number of Democrats were saying, you know what, we're going to vote along with this, and we will vote for you, House Speaker, in order to preserve some sort of sense of order. This from Florida Representative Jared Moskowitz. Massey wants the world to burn. I won't stand by and watch. I have a bucket of water. Is that true, or is that just lip service?
Well, I think you raise a good point about how Congress is facing a reckoning. We talked about a reckoning for TikTok. Congress is facing a reckoning on the question of whether it can govern. And we see these really crucial bills on foreign aid to hotspots like Ukraine, in the Mideast, and of course Taiwan, which many in Washington fear could be a future hotspot. They're beginning to see the weight of that. And, as the saying goes, heavy lies the head that wears the crown. And Mike Johnson is feeling that weight these days because does he want his legacy as Speaker to be that he couldn't govern, couldn't get his coalition or the House to pass anything? So he is willing to accept Democratic votes and support to get some of these things through.
Why are we not talking about the way that Ukraine funding is being proposed as a loan now instead of just pure aid? And this is basically a nod to what Donald Trump wanted all along. This was his proposal. Mike Johnson went and kissed the ring. Now he's saying he's proposing this. Does that have any pushback, or is this basically anything that the U.S. can give Ukraine? Let's go.
I think they're at the point where they can't be too picky. They can't be too choosy. They need to take what they can get and get whatever support, additional support they can to Ukraine right now. The situation on the battlefield is so urgent, and Ukrainian officials have made that abundantly clear during many visits to Washington, including meetings in this office with our own Bloomberg colleagues and journalists. It is really urgent for them to get this aid so that they can, stave off this intensifying Russian offensive.
When it comes to Congress, is Trump still wielding his influence? Because I was really struck that Andre Duda spent hours with him yesterday in New York. You had David Cameron spending hours with him. These are individuals who are staunchly supportive of Ukraine.
It is interesting that Trump is reaching out to these foreign leaders, including the Polish president. They do have a history there, as you remember, Fort Trump. But, the question of how that connects to his sway over Congress, I think that it's, they're sort of parallel things. These leaders recognize that Trump very well could be the next president based on the polling, including Bloomberg's own Bloomberg Morning Consult poll, which shows him ahead in key swing states. And they have to make this outreach now. They have to build this bridge now rather than wait until he's sworn in to at least understand what the former and potentially future president may be planning.
When it comes to China, there's not going to be a lot of difference between Biden and Trump. And I'd love to get your sense, because we're hearing so much about the China EVs potentially on tap. How are you reading the tea leaves?
Well, the tea leaves, I think you read it really well, Anne-Marie, that between Trump and Biden on China, there is not a whole lot of daylight. Where you'll see differences are in specific areas of policy. Yesterday, we saw Biden calling for 25% tariffs on certain Chinese steel and aluminum products. Naturally, he made this pitch in Pittsburgh as he was defending U.S. steel being in American hands. So that does sound like something that Donald Trump would say. Would he write the policy exactly the same way? Not totally sure, but it doesn't seem too far, too much distance between the two of them.
How dependent are we on Chinese steel in this country?
The demand for last year was $1.8 billion, so it's 0.6%.
Not a lot.
Not even a percentage, exactly.
Every story, every single story, and I'm not talking about our stories here at Bloomberg, of course. I'm talking about every story outside of Bloomberg needs to have that quote in there. It needs to, because this is about political messaging. This is not actually about economic consequences or anything like it.
Absolutely, and if it was bigger, you'd think they would have done this prior. They wouldn't wait till just a few months before the election standing in Pittsburgh. The one place that when I talk to officials over the past few days they're concerned about is Mexico, and that's what Leland Miller was talking about. If China dumps on Mexico, how does that just easily leak into the U.S.?
It's fascinating. Shep, this was great. It's fantastic to see you in person. Thanks for having us.
Yes.
Michael Shepard here in Washington, D.C. Coming up next on the programme, we'll catch up with the former IMF First Deputy Managing Director, John Lipsky. That conversation just around the corner. Live from Washington, D.C., with equities doing a little bit better on the S&P 500, positive by 0.25%. In the bond market, yields, can we call this stable? I won't use the word calm, Bramo, but stable for now.
Yeah, sure. But, wait a couple minutes, see what happens. Remember yesterday? We started a little bit up, and then, whoo, we got the, earnings. We got concerns about other things. I don't even know what happened.
457.92 on a 10-year. Live from Washington, this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
DOJ or other authorities
Could face bigger challenges. Britain's next.
Fed was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Things are steady. We're doing okay. Equity futures are positive by 0.2% on the S&P 500. The move in bond yields just shifting a little bit lower recently as well. There's your S&P 500 up 0.25%. The Nasdaq up by 1/3. If you switch up the board and turn to the bond market, the 2-year, 10-year, and 30-year just settling down a little bit. We were talking about 470 only yesterday on a 10-year. Now we're talking about 458 on a 2-year. We breached 5% twice in the last week. We're back down to 493.48. As our good friend TK might say, Bramo, crisis over in the bond market. Would you go that far?
Well, come on, you know that I'm not going to go that far. You're just setting me up to wind me up. I mean, look, this is the issue, is that we've seen these moves every single day. If something happens, you get a 20 basis point swing. You know, if nothing happens, maybe you kind of meander around the same place and you'll get some buyers coming out in the corners. But you got headlines like today, Vanguard coming out, saying all it takes is heading to 475, 4.75% on the 10-year. And suddenly all the potential buyers get pushed out of the water, and all of a sudden you get straight up to 5%, and oh my God, Armageddon for everything. So, you know, you have all of these potential scenarios, and right now it's calm.
No Armageddon right now. Let's switch at the board. Potentially Armageddon in foreign exchange. The dollar's weaker. Everybody's seemingly outside the United States hoping for some dollar weakness, and that's what you've got on the screen at the moment. Just a little bit against the Korean won, a fair bit, to be fair. And we should probably talk about what's happening in Asia, because I think it's really important. South Korea and Japan are threatening to intervene. Malaysia actually has done. And this stronger dollar story, Lisa, is poison for some of these authorities because they can't do much about it.
Well, they can't do much about it, especially if they need to cut rates, and especially if they need to keep a looser monetary policy, I should say, because for the ECB, it's cutting rates, and for the Bank of Japan, it's avoiding hiking rates further. The question is, if the U.S. is truly exceptional in terms of its growth and inflation doesn't come down, what else can you do without responding from some sort of monetary policy type of level? And that's something they don't want to do.
The Japanese finance minister coming out of his meetings had this to say: I hope you'll read the statement as it is. It is serious concerns rather than ordinary concerns.
Serious, not ordinary.
Serious rather than not ordinary.
It was serious at 152, more serious at 153.
Just continuously
more
gets
serious
more
at 154. Serious. Okay, let's turn to our top stories. Under surveillance this morning, President Biden turning up the heat on China, calling the country, quote, xenophobic, and highlighting their economic problems during a campaign stop in Pennsylvania. I have to say, AMH, that's some pretty strong stuff to accuse a country of being xenophobic.
Absolutely. And when you heard similar rhetoric from the former president, there was a lot of pushback.
Outrage.
Outrage. This is what Beijing had to say early this morning. I saw their statement. I would like to ask him, this is Beijing's foreign affairs spokesperson, to Biden, are you talking about China or the U.S. itself? So what they're talking about is basically, how are you saying we are xenophobic when this language continuously comes out of the United States?
Yeah, that's going down a messy path. Let's put it that way. Focus on trade and economics, and we'll do our best to do that around this table too. Let's talk about some of the earnings coming out of Asia. Taiwan Semiconductor enjoying its first quarterly profit increase in a year. Strong AI demand, reviving growth at Asia's biggest company. TSMC also delivering a better than expected outlook. Shares of the chip maker up more than 35% so far this year. Lisa, some decent news on the earnings front.
Yeah, well, today we heard decent news. Yesterday, we got ASML out of the Netherlands, and it came out below expectations. They said it was just a corrective cycle. Which is it? Yesterday, we saw NVIDIA go down. Today, we're seeing it go up. And it's sort of like, pick your narrative on each day within specific sectors or within the macro. And I think that that's sort of my takeaway from this. It's sort of unclear what this means for Apple. It's unclear what this means for the semiconductor super cycle.
We just went from one story talking about the increased rhetoric, the acrimony between Washington and Beijing, and then we're talking about how TSMC is just absolutely nailing it. There are concerns, long-term concerns, not just about the pathway for AI and how long this rally can go, but also how safe the Taiwan Strait can be. Every time I think of the TSMC, I just come back to the constant friction between these two countries, China and Washington, and how this is a company that is bang in the middle.
Dominating the meetings here in Washington this week. Elsewhere, a slew of Fed speak on deck today. We'll hear from Bowman, Williams and Bostic as strong US data and sticky inflation leaves traders reconsidering the path for rate cuts. The IMF's World Economic Outlook describing the US economy as, quote, overheating. Former First Deputy Managing Director John Lipsky writing, quote, despite the first quarter CPI data, it isn't clear that inflation is accelerating, calling into question the claim of overheating. John joins us around the table. John, hello and good morning.
Good morning, Jonathan.
We've got a lot to talk about, And I think you're the ideal person to talk about some big issues here in Washington. It strikes me as interesting that we are lacking an institution who is really coming out swinging and fighting against the drift towards industrial policy and protectionism over the last few years. How can an institution like your old one, the International Monetary Fund, regain that relevance so they can help shape and guide us towards more optimal outcomes?
Well, it's a good question. And of course, the institutional response to the global financial crisis was to create the G20 leaders, and they took it on themselves to take the leadership role in these kind of issues. And what you see is the inability of the G20 structurally to deal with controversial issues like this. They can't even agree on a communique at the ministerial level. The fund is going to have to keep working. There's no easy way because there's so much, as we just heard, there's so much politics and geopolitics involved in this policy. Or this move toward more protectionist policies. Despite that, global trade is growing this year. So there's still a gap between the reality and the rhetoric. The important and the difficult prospect is that this trend will continue and protection will become more embedded through industrial policy or other protectionist measures.
What do you think, John, right now is the epicenter of global instability? I think a few years ago we might have said China. Could it possibly be the United States and U.S. policy now?
Well, the U.S. is, as the IMF World Economic Outlook pointed out, is performing in an exceptional way. The question is that sustainable or temporary? Is it produce as we said, you said just a few minutes ago, the IMF called it overheating. But that's not so obvious in the data. And the IMF's own figures point to an easing in growth in the U.S. next year. So it seems to me that it'll be more important to look at the underlying causes of stronger growth in the U.S. Why is growth in the advanced economies is weak, and in the emerging and developing economies falling far behind? As the IMF pointed out, only the U.S. has got GDP output at this time above what had been expected before the pandemic. Everywhere else is behind, and for the poorest countries, they're the furthest behind. In other words, scarring has been important and more important for less developed countries. This was going to require not just rhetoric, but some deep thought and action of how to boost productivity and growth in these countries.
It's fascinating that in this memo, in this statement, they talk a lot about fiscal debt. They talk about the U.S. debt in particular as being problematic, when some might argue that's the reason why the United States doesn't bear the scars of the pandemic. What did you make of that?
Well, they themselves said that the exceptional growth was due in part, or in large part, to more expansionary fiscal policies. But it seems to me that we're going to have to look and think about, is it, for instance, labor market flexibility, differences in labor market flexibility that have produced some of this result? Remember, in Europe, the response to the pandemic was to provide a boost that tied workers to their job. And so it meant after the pandemic, everyone went back to the same place that were before. In the U.S., the support was much more to individuals, and you've seen much more scrambling of the economy in terms of which sectors have surged forward, and the more flexible adaptation of technology here than elsewhere. So there's much more to it than just fiscal policy.
To piggyback on what John was talking about how no one's really beating the drum right now about free trade and the concept of what that can do to the global economy, do you think that this is an IMF that can survive?
Oh, yes, absolutely. What I think has the recent developments have shown is the importance of multilateral institutions as a place for dialogue. Obviously, we're going through a very difficult time. I think back to my period at the IMF during the global financial crisis. There was a real sense if we don't hang together, we will all hang separately. And you didn't have a sense of great power conflict in trying to figure out how to move forward. I think what we're seeing now is an environment of conflict of still uncertain degree, that the global economy is not performing well. As the IMF points out, global growth is slowing. I think that it's going to take, obviously, return to effective multilateral action, open markets, open financial markets, open trade markets to get global growth back growing again. So these institutions are going to be critical, but it's not easy because for obvious reasons.
John, how is that possible when you have the current administration talking about even more tariffs on China and the potential next administration, if Trump was to get back in, a 10% wall on all imports into the United States, 60% on Chinese imports?
First of all, it's not obvious industrial policy is going to produce good results. It hasn't in the past. It's not obvious that protection is going to produce better economic results. In fact, it's likely to produce higher inflation. And if there's a risk that markets perceive, that investors perceive, it's if we turn towards accelerating or higher inflation over the medium term, people have based their own personal financial situation on an expectation of continued low inflation in the future. If that's not going to be the case, there's going to be a reassessment, a really profound reassessment of the outlook that could produce pressures on fiscal policy, because that means higher interest rates, higher debt service costs. It's going to start eating up budgets. It's going to put governments in a much more difficult position. So all this talk about protection, industrial production, continuing substantial deficits, really is going to, I think, likely to eventually undermine the medium-term outlook and have to produce some results.
If the world stays on that path, where are the consequences going to be felt most acutely?
Well, so far, it's the poorest countries that have suffered the most from global inflation, from disruption, et cetera. They're the ones who have suffered, and they're the ones least responsible for what has gone on. Happily, the multilateral institutions still exist for a dialogue in which these issues can be dealt with. Not solved quickly, but if these institutions went away, we would feel their loss intensely.
We started the week with our good friend Mohammed Al-Arian, and he said he wasn't confident, he was hopeful. Are you hopeful about addressing some of these issues, or confident we will?
I'm hopeful.
Yeah, I thought so. John Lipsky, John, thank you, sir. Really smart stuff, as always. Appreciate
you so
it.
much.
Thank you.
It's always a pleasure.
Thank you very much. John Lipsky there, the former First Deputy Managing Director of the International Monetary Fund. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief. We can catch up with Danny Berger. Hey, Danny.
Hey, John. Jury selection resumes today in the Manhattan hush money trial of Donald Trump. 7 jurors have been sworn in so far in the first ever criminal case against a former president. The selected jurors include 4 men and 3 women. 11 more spots, including 6 alternatives, still need to be filled. The trial is expected to last between 6 and 8 weeks. It convenes every weekday except Wednesdays, and of those, Donald Trump is required to attend every single day. Doha's Hamad International has been named world's best airport. It edged out 12-time winner Singapore's Changi in the Skytrack World Airport Awards. Asia had a strong showing in the top 5. Seoul and Tokyo's twin facilities took the 4th and 5th spot. Hong Kong's airport saw a significant boost. It's moved up 22 positions to 11th place. The World Health Organization is wading into the world of AI, but not always with the best results. And unveiled a new chatbot that, yes, it's available 24/7 to provide basic health information in 8 different languages, but the WHO warns that some responses may not always be accurate. Some of the model's training is years behind the latest data, and the bot occasionally provides weird answers to users' questions, what's known as hallucinations in the AI world. That's your brief, John.
Danny, thank you. Based on the pandemic, I'm not sure if I'm more concerned about the WHO or the bot that comes out of the WHO.
My advice, and I shouldn't be giving anyone medical advice, is do not use this and go see a doctor.
Yes, that's good advice. Good advice.
I mean, all of us have used Google. Come on, Dr. Google, haven't you done that before?
Pretty much every single symptom.
100%, you have cancer.
I know. Up next on this program, banks navigating through uncertainty.
There are still big macro risks in the marketplace. Strength and stability seems to be a bigger presence in the strategic boardroom of these banks. They are building these banks to make sure they can withstand any challenge.
This show is becoming very depressing today, isn't it?
I'm sorry. I'm going to try to be more optimistic.
I'm going to go and catch up with the managing director of the IMF.
Try to get more optimistic.
So you enjoy yourselves.
Thanks.
Or not. Whatever. Take your pick. From Washington, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Was it me? John left. I don't know. He's going to go.
I think it was you.
All right. Well, it's all right. Dark. Welcome back. This is Bloomberg Surveillance on a dark and stormy day. Actually, it's not. It's actually a very energetic morning here in Washington, D.C. We do see a bit of a bounce in markets, but it is the IMF meetings that really is front and center. S&P futures up about 1/3%, trying to climb. Euro dollar basically flat as you hear verbal intervention or the attempts of it, with people worried about a strong dollar. 10-year yield doing absolutely nothing right now as we try to parse out how we think about the fiscal deficit, how we think about inflation, how we think about a Fed response, and frankly, the fact that you're still getting 4.6% on a 10-year yield looks pretty good and people are buying. Right now, under surveillance this morning, let's get straight to it. Banks navigating through uncertainty.
There are still big macro risks in the marketplace. And I'll tell you, when I talk to bank management teams, it's almost like I feel like I'm having a credit analyst discussion more than an equity analyst discussion. They're very focused on their own balance sheet. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks. They are building these banks to make sure they can withstand any challenge.
Here's the latest. The IMF lifting its expectations for global growth, but warning financial institutions of headwinds, including persistent inflation, rising geopolitical tensions, and key elections in some of the world's biggest economies, including the United States. Tim Adams, CEO of the IIF, writing, quote, instead of talking about flexible exchange rates, we're talking about how to prepare for a world that is getting more and more dangerous. For the first time, geopolitical risks are the #1 focus, especially the U.S. election. Tim joins us now. Tim, wonderful to see you.
Well, good morning. Good to see you.
You know, it was really interesting when I was reading your notes. You talk about how usually it's something of a sleepy affair. People kind of get together.
Pretty subdued in the spring.
Subdued, bureaucratic kinds of, hubbub. This is different. Why?
Geopolitical risks. People are concerned. You have war in Europe, war in the Middle East, which could grow, tensions in the Asia Pacific. So it feels like a very dangerous world. People keep making allusions to the 1930s. I think that's probably overdone, but certainly something we should consider.
Part of the problem with some of these discussions is it's very hard to know how to prepare for something where it's a very bipolar kind of outcome. Are people actually hedging that kind of risk, particularly with the respect of the areas that might get hit hardest in the economy as a result?
Yeah, everyone's preparing because you just don't know. The uncertainty just overwhelms all calculations. You know, the economy is good. As you noted, growth is exceeding what was expected this year. The U.S. economy is humming right along. So from just a growth perspective, we're exceeding expectations, but people are still nervous.
Is the U.S. economy too good in terms of it's so good here that it's dealing with some pretty fraught consequences around the world?
Well, I don't think it'd ever be too good. I think there is other countries looking and saying, how can we replicate that? And why aren't we doing what the U.S. is doing? The U.S. consumer continues to power ahead. So I think there's something to be said for that. Maybe lessons to be drawn from the U.S.
But the U.S. is doing more of industrial policy, especially fiscal policy, loose fiscal policy. The IMF report has talked about this. Do you hear other countries saying, well, if we're not going to have as robust global free trade, that's the direction we need to lean into?
Well, I would hope we go back to robust global free trade. I think that's the right answer. The fiscal deficit, 6% of GDP, is not sustainable. There is a lot of fiscal support. Debt and deficits are part of the conversation this week. I think there's a lot of concern about where we're going to be and the sustainability. I don't think it's sustainable. But right now, it's providing a real pulse to the economy.
So let's take a step back and talk about what the main issues are that financial firms are looking at and actually trying to hedge against as they prepare for this more dangerous world in a whole host of different ways. You point to oil in particular and saying that it could surge 40% globally next year, or even this year, if you start to see a protracted and escalating conflict in the Middle East. Do you see firms actually preparing for that, or do you see them as incredibly vulnerable to a situation like that?
No, our firms are in the risk management business. They're all looking at different scenarios and have for some time. You know, it's not a surprise that oil prices could surge, but it's energy prices generally, and that goes back to industrial policy. If you want to support manufacturing, energy prices are one of the most important component input to manufacturing. So it's not just throwing more fiscal dollars at a certain sector. It's how do you get energy prices at appropriate level.
I hear you talking about how they're prepared for it. They're in the risk mitigation business. We hear that in a host of different ways. Does that mean that you don't see the likelihood of some sort of banking crisis or some sort of banking kerfuffle, or whatever you want to call it, akin to what we saw even last March, just simply because they are prepared for higher interest rates, they are prepared for higher oil prices, they are prepared for a potential slowdown?
No, the system is highly capitalized. We have a tremendous amount of liquidity, very good risk management systems. What we saw a year ago was pretty idiosyncratic. So I feel pretty good where the industry is, but every day, we're spending an entire week scenarioing out different risks. So we are trying to think through what are the array of possible downside outcomes.
One risk that you mentioned when you talk about geopolitics that I thought was fascinating, you talked about the U.S. election, and that was actually one of the geopolitical risks that a lot of people were looking at. What are people expecting from a Trump presidency 2.0 in terms of either deregulation? Is that really the case? Can you game that out?
Sure. I just did a 9-city, 17-day tour across Europe. It's the first question out of everyone's mouth, what's going to happen on November 5th, 201 days from today? And the concern is, what is a Trump administration? I think actually it'll be business-friendly. I do think there's protectionism. I do think we'll see tariffs and non-tariff barriers. I don't think we'll see deregulation for our industry. I think that's come and gone. So I think there's a lot of potential chaotic outcomes, just the uncertainty of what a Trump 2.0 would look like.
What kind of tariffs do you actually see potentially happening? They talk about a 10% wall and all imports coming to the United States, and then 60% on Chinese imports.
Yeah, I think it's just part of a negotiation, right? I think that's the opening bid. But I do think there is a proclivity to believe that somehow The biggest challenge we have in the United States is our global imbalance, the external imbalance, and we need to solve that particular equation. I don't think that's the problem, and I think you could end up doing some really bad policy in pursuit of an objective which I think is of secondary nature.
But whether or not it's Trump or Biden, you see the direction of travel the same when it comes to potentially more tariffs on places
certainly
like
on China. China is on the ballot, irrespective of who's elected or who's running. Yes.
Which raises the question for banks, and this is something that we've heard and seen quite significantly. If you're an international bank, do you get into China? Do you expand your presence? Or do you really curtail it in a more significant way? We saw yesterday Morgan Stanley pulling out a couple of its bankers from the region.
Yeah, I think it depends on the institution. You see some institutions are doubling down and others who are withdrawing. It really depends on your risk profile, your appetite for risk, and you know, where you're located. I think I'd be cautious being in China, but certainly you can't walk away from the second largest economy in the world. You have to be there, and your clients want you there. So I think you do so cautiously.
So this raises this question because we keep talking about how this is a whole new world, and there is an increasingly protectionist kind of feel at this IMF meeting, and this feeling that free trade isn't as good as it really was thought up to be. Is that the same tone that you're hearing from the members of the IIF?
It's a concern that we're hearing. You know, my industry tends to be for free trade, free flow of capital, free flow of data, free ideas, right? We think that's how you optimize growth. But we don't hear that coming out of political capitals. You hear politicians who think they can micromanage their economies into a better outcome. I think that's a huge mistake.
So what's the biggest risk then right now? Is it the politicians?
Well, it's the politician and misallocation of capital, which won't show up for years, but we can end up wasting a lot of capital pursuing sort of pipe dreams of politicians who think they can outsmart the markets.
So we're here for the IMF spring meetings. How does the IMF as an institution, do you think, really guide the global economy and companies that you work with?
Well, they can provide some intellectual framework, some analytical framework, which is if you choose A, this is B happens. So I think showing trade-offs. I think trying to hold the sector, the global economies are honest. You've got finance ministers, central bankers sitting around the table. They can be voices of reason. They can talk to the political leaders. Ultimately, it's about political leaders taking political decisions.
This morning, and I can't let you go without asking this because it's something that's very much on my mind, Vanguard